also what looks to be a neutral rate, and inflation's not at this 5 or 6%.
Subhadra Rajappa of SocGen still with us. Subhadra, I want to bring you into the conversation on that. Is this an issue that the Fed has to weigh? Maybe not at this meeting, but over the coming meetings, how they're contributing to broader financial conditions?
Yeah, I think it's definitely a concern for me. And to me, at least the way I look at it, this doesn't feel like the environment where the Fed should be delivering a lot of preemptive cuts or cutting as much as what the market is pricing in by the end of next year. To me, that kind of path feels like it's a little bit aggressive. I mean, the growth trajectory for the third quarter has been extraordinarily strong. The Atlanta Fed GDP now is tracking close to 4%. You're looking at an employment picture that's kind of deteriorating, but not terrible. Inflation is still high and sticky and well above the Fed's mandate. So to me, the market kind of getting ahead of itself and pricing in too many cuts seems like it's a bit much. And then you add in easy financial conditions, you're left with an environment where maybe the Fed has some sort of leeway in trying to not ease as much in this environment.
Subhadra, I'm going to pick up on Bob Michael's insight there about what I call log convexity. Are you seeing out there not bubble tendencies, but are you seeing on a log plot, a logarithmic plot, a convex acceleration where things are getting a little bit effervescent out there, a little bit exuberant?
So to me, what is concerning is the fact that there's absolutely no volatility in the market. Look at, bond volatility. You look at implied volatility in the bond market or in the equity market. There's absolutely no concern. So to me, the lack of volatility in this environment is also troubling because you tend to see a lot of investors kind of getting lulled into a sense of security and continuing to sell vol anytime you have a pop in vol. And that's an environment that is concerning, given the fact that we do have a decent amount of risk. We're going through a shutdown right now. There's potential for meaningful deterioration in a lot of these fundamentals that we're looking at. And we have no clarity on the data. So I think a little bit of caution is required from that perspective.
Subhadra, somewhere in this country, there are some college kids, maybe the Finance Society at the University of Alabama, taking bets on just how soon this news conference will end as soon as it starts. Are you betting on a short one today? What can he possibly say about what they don't see at the moment?
He's going to get his slew of questions from everyone, including Mike McKee. So the press conference will probably at least run 30 minutes or longer. He might get into the details on QT if they do announce QT. So I'd be curious to hear what he has to say. And he's probably going to also kind of elaborate on the data points that he sees, because the Fed does have a lot more information that's available to them. And he might kind of enlighten us a little bit more on what they're seeing and hearing from their constituents. And that should shed some light on what they're thinking on policy. We'll also be curious to hear what he says on what he's going to be doing at the December meeting. Although they don't have a whole lot of information, the market's already fully priced in a cut. We'll have to see how he kind of discusses that.
Subhadra, thank you. It's good to see you. Subhadra Rajappa of SocGen. Those college kids will bet on anything, TK. You notice that these days? Absolutely anything.
Yeah, I've been in front of some of them recently, and they're eager to learn, and their heads are spinning like ours are spinning over this moment we're living in. I'm still saying it's coming out of COVID. We're maybe beyond that somewhat here there, but now we have this shutdown. You said the word when we came in here in our show preparation. The first word out of your mouth was odd.
It's an odd one.
You said it's an odd meeting.
The only data we have, the most recent data, the only data we have is inflation and headline and core around 3%, and the Federal Reserve set to cut interest rates at 25 basis points. I understand why, because they're worried about the labour market, but it's a kind of awkward situation not to have that official labour market data and still to be looking to cut interest rates with inflation around 3.
And again, the dovish, hawkish tilt of a traditional Fed meeting, maybe it's out the window. We'll have to see.
That Fed decision just around the corner. Let's check out the market. Start with equities. Equities this afternoon positive for a 5th consecutive session on the S&P 500, up by 0.2. In the bond market on 2s, 10s and 30s, a snapshot of fixed income yields higher at the front end of the curve by 2 basis points, likewise on 10s. With that Fed decision, here's Mike McKee.
A divided Fed cuts their benchmark lending rate by 1/4 percentage point and says they are going to end QT December 1st. There are 2 dissents as policymakers reset the target range to 3 3/4 and 4%. No surprise, Stephen Myron dissents in favor of a 50 basis point cut as President Trump wants. And Kansas City Fed President Jeffrey Schmidt dissents on the other side in favor of no move. The Fed's administered rates for interest on reserves and the primary credit rate mechanically decreased by 1/4 percentage point along with the Fed funds target. As for the balance sheet, the Fed will stop redeeming maturing Treasury securities at the end of November. Principal payments will be rolled over going forward. The mortgage cap of $35 billion a month remains in place, but as of December 1st, all principal payments on maturing agencies will be reinvested in Treasury bills. Fed officials gave a nod to the government shutdown in their economic assessment, noting that, quote, available indicators suggest that economic activity has been expanding at a moderate pace. Job gains have slowed this year, the statement says, and the unemployment rate has edged up but remained low through August. More recent indicators are consistent with these developments. They changed the tense on the balance of risks, noting downside risks to employment rose in recent months instead of have risen. And uncertainty about the economic outlook remains elevated, they say. There is no change to their forward guidance. The statement still says in considering additional adjustments to the target rate, they will consider many factors. Guys?
Mike McKee, stay there. What a decision by the Federal Reserve. So you cut interest rates 25 basis points, widely expected. They MQT. A lot of people were talking about that coming into the decision. But the headline here is just how divided this committee is. Dissent cutting both ways. One saying keep policy unchanged, another saying let's go even harder and come by 50 basis points. Equities stay elevated, up by 1/4% on the S&P 500, but a bit of a turnaround in the bond market. Switch on the board and gets the fixed income. 2s, 10s and 30s. Bond yields just slightly higher by 3 basis points on 10s at 4.01%. TK, these aren't major moves in financial markets, but there is a subtle shift in this Federal Reserve. It's divided, and when you're this divided, it's difficult to provide guidance about what you're going to do next. Because if you're trying to lead this committee, trying to reflect a consensus that doesn't exist is basically impossible.
Edge of Bank of England. It's the first thing I thought about. I've got to go back and study when the last time this really happened, where you had one up, one down, one hawkish, one dovish as well, pushing against the chairman. And it speaks to the 2 parts of the country that are out there. My idea that there's 2 R-stars. You see it with the shutdown again, and part of America flat on their back. You've got, it's amazing to me to see Myron 50 beeps in, John, and let's say you want to go the other way, it's a 75 beep gap. I don't believe I've ever observed that. I'm sure I'll stand corrected, but there it is.
The last time we had a dot plot, there was massive dispersion. I think you know whose dot's at the top now, and we knew whose dot is at the bottom. Mike McKee, I believe is still with us. Mike, the credible argument here, are there credible arguments to do nothing and credible arguments to go even harder?
Well, the credible arguments to go even harder are a little bit harder to make because financial conditions are pretty easy right now, and the markets have been soaring in recent weeks. No change there. We did see interest rates rise a little bit this week as perhaps the markets got a little concerned about inflation going forward. Jeff Schmidt's case is probably easier to make in the sense that inflation is still rising, even if we are seeing the Fed cut rates. That could only be a problem going forward, is his view. And there are people on Wall Street who certainly share that.
Michael McKee, thank you, sir. You get into the news conference. Mike McKee there breaking down this decision. The Federal Reserve reducing interest rates by 25 basis points this afternoon.
2019, we had George and Rosengren say no rate cut at all, and Bullard said a dovish dissent. That's some of the tension, but I would suggest today's meeting has even greater tension than what we saw in 2019.
Bob Michael at JP Morgan Asset Management still with us. Bob, just your early reaction to this call and that dissent.
I don't think it was at all surprising. The 2 dissents could have been a bit more interesting. I think Myron could have gone for 75 basis points. After all, he wanted 50 last time. Sure. So there's 25 that he's owed, plus another 50 this time. That would have been fun. And Schmidt, where was he last meeting? Where was he last meeting? Now you've had more evidence that the labor market is feeling a bit spongier and inflation's not as much of a threat as we thought back in September, and suddenly he reemerges. To me, it tells me that Powell is losing his grip on the Fed.
Let's extend the conversation with the former Fed Vice Chair, Rich Clarida. Rich, welcome to the program. Bob Michaels saying the chairman might be losing his grip on this Fed. Do you agree?
I don't think so. You know, going into the September meeting, I thought we might see President Schmidt dissent. And so I do think Powell really focused in September on keeping the committee together. But I expect to see more of this in the remainder of Powell's term for sure. If you just looked at the dots in the speeches, you have a pretty divided committee in terms of the case for preemptive cuts from here with inflation at 3%.
Richard Clarida, I've got to ask you the important questions here about the future of the Fed as well. John Farrell mentioned the Secretary of Treasury would make a pretty darn good chairman. That's out there in the zeitgeist right now. How important is this date of October and moving into December and really firming up the debate over the next chairman of the Fed?
Well, they have indicated, and I do expect that the White House will announce the nominee by the end of this year. And I think it is important because it will take some time for that person to get confirmed, and the transition will be relevant to markets. You know, the short list says anywhere from 3 to 11 names, and perhaps you could add Bessent to that. So still a lot to figure out.
I mean, it'll be interesting to see how we figure it out if we assume a December rate cut. John, that's pretty much consensus, right?
I don't know, Tom. You know, I really don't. Are we going to have some data? Does the government shut down?
We may get some data. We'll have to see.
Do you get a bounce back in the labor market?
Where are we going to be in January? I mean, I need to understand the vision to get to January in that room that you as vice chairman have been in.
Well, I think you go one meeting at a time. I think, especially where we are, given the uncertainty about the data flow. But Tom, I do agree with you. I think it's just natural as we move into 2026. You know, markets are forward-looking, and markets are going to have to telescope in what they expect the new Fed chair and what his or her priorities to be. And so I think December is something we'll be looking at, but then as we get into next year, that becomes relevant to markets.
Hey, Rich, TK often brings up the Bank of England and the amount of dissent we get over in the UK on Threadneedle Street and the difference with the United States. I think we've been conditioned by the leadership of Greenspan just to believe that the chairman has this immense power to lead the whole committee. Rich, do you think it's going to be getting difficult and more difficult to govern this committee into next year, even if you select a super dovish Fed chair? How hard would it be to get things your way?
It's a good point, John, because in practice, you know, and I do it myself, the Volcker Fed, the Powell Fed, but it is a committee. It requires votes of the Federal Open Market Committee. Oftentimes inside the building, the power of the chair is the power of persuasion. We've had some pretty persuasive Fed chairs, but there have been dissents. I think the key thing that we might start to see more of is dissents by governors. In the last 30 or 40 years, dissents really since Greenspan have been typically concentrated among the Reserve Bank presidents, and so that could also become a factor as well for the new Fed chair.
Rich, let's spend some time on this news conference. I imagine there'll be questions about what is guiding this interest rate decision, and for that matter, to Tom's point, what will guide the next one? Let's assume the government shut down. Rich, what is the data they can point to right now they're going to be leaning on, and how do they really flesh out their reaction function to non-traditional indicators? I think we're all familiar with how they respond to, say, non-farm payrolls, the unemployment rate, and CPI, but if you don't have that anymore, Rich, how do you communicate?
Well, it's tougher. You know, there are alternative sources, ADP for employment and, you know, the Billion Prices Project for prices. But I would agree, John, the further this goes on, the trickier it gets really to make an affirmative case, especially right now. Let's be honest, you know, the justification here in September and now is really a risk management consideration. And, you know, but let's be honest, that goes both ways. There's downside risk to the labor market, but there's potentially upside risk to employment. So risk management becomes trickier as well with little data.
John Farrell and I took Behave Yourself 101 and Don't Be Rude, so I'm not going to ask this of Vice Chairman Clarida. I'm going to ask it of you, Bob Michael. We have Chris Waller with a definitive 1991 paper on game theory and the Fed. He and I covered that the other day. We have Richard Clarida with arguably the definitive 1999 paper on not so much the history of monetary policy, but the mechanism that we have. How critical is it to you and your bank that we have a next chairman who has prodigious monetary chops?
It's important. You need to have someone there who understands that the Fed, I believe, controls the purse strings to the U.S. economy. So it's an awesome responsibility. I think Rich hit the nail on the head. You don't only need a dovish Fed if you're the administration. You need a persuasive appointment to head the Fed. And that's a rare combination. And there's one guy we know in the administration today who's been shockingly persuasive. If you go back to April when everything was falling apart, who's the guy who stood on the White House lawn and calmed everything down? That was Scott Bessent. And I think you have to put him into the Fed if you're the administration and you want to see rates at 3% and lower, and have him lobby and create the persuasion.
But on a daily basis, he's monitoring his president. He's assisting his president as Secretary of the Treasury. That's a huge vacuum if Bessent goes over to the Eccles building.
Yes, but as you said, you need some street cred, and he's got it from being Treasury Secretary. And he does have a view. He does believe fundamentally lower interest rate environment frees up businesses and households, and ultimately that's good for the U.S. economy.
Bob, I think
you can't fault him on that.
Both you and Rich are exactly on the money, and a lot of people following this situation agree with you. TK mentioned Neil Datta a little bit earlier on in the program. If you want a Fed chair that's going to lean towards rate cuts and can influence and persuade the rest of the committee, he's already on the FOMC. It's Governor Chris Waller.
Yeah.
The outstanding question at the moment is whether the president wants to go along with him. Rich, you've sat in the room with the president of the United States and you've had these conversations. What are the interviews like, Rich? What does the president ask?
Well, that's probably for my memoirs. I enjoyed the interview. It went quite well. But let me just say this. You mentioned Chris Waller. I had the privilege of working with Chris closely, and I admire him as an individual. I admire him as an economist. He's had some good macroeconomic calls, and so there are other strong candidates as well. But Chris checks a lot of those boxes for sure.
Rich, we'll keep you out of trouble. It's good to see you, as always.
Please,
the former Fed Vice
John.
Chair, Richard Clarida. Rich, thank you.
He can't get off soon enough.
He wants to sell books in a few years, TK, and tell everyone about those interviews. Diane Swanker, KPMG, jumps on now. Diane, welcome to the program. Decision 15 minutes behind us. About that news conference, about 15 minutes in front of us. What's the big takeaway this afternoon?
Well, instead of a dual mandate, we have a dueling mandate, and that's what you saw. We had 7 people that had on their dots either no cuts or only the one cut that we had, and dissents are rarely done in a vacuum, and I think Schmid's dissent was also in line with another 6 of those 19 participants that did not think we needed any additional cuts right now, and I think that's what was important. I think it was very important with the first meeting with Governor Moran at the table, knowing that he was going to dissent and be an outlier on the dot plot, that you showed solidarity within the Federal Reserve, but we are going to see a lot of tension going forward because this is a really difficult time. 1, we're flying blind. 2, we've got inflation is up, and unemployment is edging up as well, and the labor market is slowing. You add all of that together, and you get this sort of stagflation whiff, which is what makes this Fed likely to have more dissents that go in both directions going forward.
Diane, as always, absolutely nailing it. And Diane, in many ways, not news, because we saw this in the dot plot last time around, just massive dispersion, a huge difference across the board with different Fed officials and what they expect policy to change and how it's going to change in the year to come. Dan, you mentioned inflation, and I think we've got to talk about this. This is an interest rate cut that comes a week after an inflation report that showed inflation at 3, not at 2, but at 3. How credible is that pursuit of 3%, given that we've missed that 2% target, for so long?
Well, that's what the concern is. The argument, I do think that Jeff is sort of on a little bit firmer footing here. We know that this is a risk management cut. It's not clear that rate cuts alone will actually stimulate employment in this economy right now. I think there's some structural issues that are suppressing employment, which makes it much harder for the Fed to actually have an impact on employment. And lower interest rates tend to accrue to higher income households more than they accrue to lower income households. So, that doesn't help the inequality problem that we already have out there. But I think it's really important to understand that we've got this situation where 40% of that CPI was imputed. Many of it is credible imputations where they get an easy substitute. Some of it's based on history. And if prices are changing on a real-time basis more rapidly, we don't know that. The other concern is that we have had more than 4 years where the Fed has not, the proximity to pandemic inflation, had price stability yet. And that gives us a muscle memory that ups the risk that this is not just a look-through moment. That is the Fed's, certainly Powell's base case, is it's a look-through moment with a hedge. We don't want to go too far. And I think that's very important, is that you've got sequencing of tariffs that mimics inflation, and it ups the ante that we get a more persistent bout of inflation. The Boston Fed came out October 9th with a study saying that they thought inflation expectations are becoming unmoored.
Diane, from the NBC affiliate in Chicago, I think this is so important. There's 1.9 million people in Illinois that are in food lines. In November 1, it's over. It's $187 a month benefit for food, the SNAP program in Illinois. I understand that could be fixed in one moment as the president, the Democrats decide to end the shutdown. But given that, the chairman must address that in this press conference. How will he do that?
What Powell has always done is said we're doing this for the American people, and he'll lean into those issues. I think one of the issues, the 750,000 people that are either furloughed or working without pay at the federal government, the collateral damage on contractors as well, and the ecosystems and entire communities in which they live. And now 1 in 4 children, you're talking about losing food stamps or the SNAP funding. That is huge. And, children with hungry bellies can't learn. This is very important. In fact, my son's birthday is in a week and a half, and the one thing he asked me for his birthday is to donate to the local food bank because he sees the lines already. And I think this is, I talk about breaking bread is better than breaking ties. This is a time to share your bread because it's very hard for too many.
I totally agree with you, and we all do. I think that sentiment is shared by everybody who watches this program. The risk is for a monetary policy official is that they become seduced by that argument and get themselves in a wealth inequality game and fuel exactly what they're trying to prevent. Because, Dan, if you've got assets right now, game on. Keep cutting interest rates.
Yep.
Dan, what difference does it make to the people struggling in this country at the moment that Chairman Powell and the committee cut rates by 25 basis points? And how does it tackle wealth inequality? That's the risk for the chairman. That's not his job. That's not his mandate. Right. The politicians in D.C. need to address that.
Absolutely, and that is the problem. And I've actually heard people say, hey, the Fed should cut rates because low and middle income households are struggling, it will help subprime. No. It won't. The subprime rates are so much higher that a quarter point is not going to change the affordability and the ability of those households who are already in duress to actually service that debt. And we know that from the 2010s, the inequalities worsened. We're now at what looks to be the worst inequalities we've had of the post-World War II era. 20% of households carrying the economy, 3.3% of households really driving those gains. The bottom 80% unable to do anything more than keep up with inflation. That is why the overall consumer, the overwhelming majority of consumers, feel more down about the economy than the actual economy looks like on paper. And that's because we're seeing an AI-driven boom. We're seeing a wealth-driven boom that's concentrated in very few firms and in very few households, and it's not accompanied with jobs. And those productivity gains are not showing up in wages, and they're not ameliorating inflation. So it's a very tough situation for a lot of households, but a rate cut of quarter point here or there may not even change it. And as I mentioned earlier, some of the job losses that we're seeing and the ones that are being announced are structural, not cyclical in nature. And that means that a cut by the Fed is not going to cure that problem.
Dan Swonk, Clinic, as always, wonderful to hear from you. Dan Swonk there of KPMG. Bob Michael, I want your reaction to that. I think it's so important. We've had a massive step down in payrolls. But to what extent is that cyclical? And to what degree is it structural?
believe a lot of it was cyclical, and it is becoming structural because we know AI is here today. It's no longer on the horizon. It's being used across businesses to achieve efficiency. I think the question the Fed has to answer is just how blind are you flying? And the only answer Jay Powell can give is, we're not flying blind at all. We've got 400 or 500 analysts and economists at just the FOMC alone. Plus, we've got all the regional banks that have hundreds of economists. They're talking to businesses every single day. We're accumulating that data. Here's what the data's telling us. That's what I want to hear at the press conference.
The summation, Bob Michael, of your fan distributions, this thing, this discussion, that debate, do you have confidence forward in your guesstimates that you're making minute by minute? You read Kasman, you read Feroli's weekly prospects, you sum in globally JP Morgan's fixed income abilities. Do you have confidence in any form of fan distribution forward?
I do, because what we see is a Federal Reserve that believes that a neutral rate is closer to 3%. So they're headed in that direction. We're not so concerned about inflation, even with the one big beautiful bill hitting, because you do have tariffs that are some magnitude of headwind, hence 1.5% GDP for the next couple quarters. And then you also have AI, and granted it's a two-edged sword, but that will create some efficiency. Those two things are going to be offsets to sticky inflation. We'll see how it all balances out.
Should I ask the pregnant question?
Go on,
Have you
please
let
do.
artificial intelligence into your new palace?
It's everywhere.
Literally. Okay. Pregnant pause there, if we can call that that. Okay. If you're just joining us, welcome to the program. Live on TV and radio, a Fed interest rate decision about 21 minutes ago to cut interest rates by 25 basis points. Dissent cutting both ways. Governor Myron pushing for 50 basis points. President Smith voting in favor of keeping interest rates unchanged. Something that we haven't talked about a lot in the last 21 minutes that we're going to talk about now is an end to QT. The Federal Reserve deciding to stop shrinking the balance sheet. Matt Lazzetti of Deutsche Bank was looking for that move. Matt Lazzetti joins us now. Matt Lazzetti, what are the consequences of that call today?
Yeah, I think the Fed is simply responding to the increase in funding pressures that they've been seeing in recent weeks. We've seen the Fed funds rate beginning to move up within the corridor. And I think we've always known that the Fed was going to be very cautious in their balance sheet decisions this time around, wanting to avoid what happened in September 2019, where you saw repo rates really spiking. The Fed funds rate moved outside the corridor. And I think they were just going to be always very cautious in handling that this time around. And I think that's why you got the decision today that you did to end QT beginning in December.
Matt, what does this interest rate decision achieve? What does it do? What's the channel through which that rate reduction is going to work?
Look, I think these are all quite small moves. 25 basis point rate cut was already priced in, so it's already kind of reflected in broad financial conditions. But I think it'll help to continue to support, equity valuations that are high, credit spreads that are tighter. It'll filter through into lower front-end interest rates, so help on credit cards and auto loans eventually over time. We'll have to see what happens with mortgage rates, as the chart shows there. Actually, 10-year yields are moving up on this decision, not down, and therefore it may not help on the mortgage rate side of things. But I think it's more so not necessarily the decision today, but what is the Fed going to be doing over the next 3 to 6 months, next 6 to 12 months, and how much are they going to be cutting rates over that period of time? That's what really is going to impact financial conditions.
I'm curious, Matt, if the chairman brings up productivity here. The smartest thing I've heard in the last hour as we've done this is from Bob Michael, where he said of his new palace at JP Morgan, AI is everywhere. How is the moment changing? I guess, how is the guess that you have of this moment of AI, how is it changing your view, your overlay of productivity?
Yeah, I think the productivity story is really the critical question for the Fed at the moment. And we heard this from Governor Waller in his comments before the blackout period. And it's really because we have this huge divergence between real GDP growth that is very strong, almost 4% in Q2, Atlanta Fed is tracking almost 4% in Q3, but a labor market that's weakening kind of meaningfully at the margins. And that is being explained by strong productivity gains. My own view is that, yes, some of this is due to AI, but it's mostly reflecting a very tight labor market that we had in previous years, which motivated businesses to undertake CapEx and capital deepening and find efficiency gains. Many of the productivity gains I think that we are going to see are actually further in the future. But this stronger productivity story for the Fed, I think, is one which suggests that rates most likely should stay higher over a longer period of time, and that our star is eventually going to be higher as well.
Michael Ferroli will write on this on Friday. You have to think about it in real time as seen in yield. A given company, we're showing 30,000 a door. Another company, we're showing 14,000 a door, and on and on and on. How do you, with all your experience, treat five-figure job reductions at America's finest companies?
Yeah, you accept that it's the economic reality. You accept that we're in the very early stages. You hope that new industries and businesses will be created off of the back of AI that will employ more workers, and there will be a greater efficiency. We saw that when the electronic spreadsheet replaced manual spreadsheets. We saw that in the dot-com era. Hopefully we'll see it with AI.
And Robert Kaplan, the former Dallas Fed president, was just wonderful on this the other day.
What did he say?
He said hope. He said just what Bob Michael said. It's one big academic hope by the haves that there's a good side on the other side of AI.
Luke Cower, I think, has been absolutely brilliant on this. This is regressive up front. Can hold back employment. In the near term, I hope that changes. It can boost energy prices. Electricity in this country is becoming the political topic.
Agreed.
For the next
Strongly
18 months.
agree.
Now, the argument you've got to make is that's all going to change. Productivity picks up. Great. Fantastic. But in the here and now, isn't that a bit of a stagflationary story? If you strip out what is happening, say, with energy prices, electricity taking off, if you look at what's happening with labour market, holding back employment, isn't that a bit of a problem for this committee?
I don't think so. I think that they're comfortable looking through inflation, and if there is a problem in
no doubt, they've done that for 5 years.
But if there's a problem in the labor market, that in and of itself will hold back some inflation.
We have 25,000 employees. You are the most qualified one I know to talk about electric bills. What does America face if we have some semblance of the electric bills of Britain?
I know, Mum. Don't worry. I'll take care of it at the end of the month. It goes something like that.
That's how it goes.
Yes, it does.
Okay, that's real, folks.
The energy prices in the UK are absolutely brutal. They're absolutely brutal. And if you face anything like that in the United States, you're talking about the wealth inequality in this country right now. We're lucky to have the energy prices we have because they're so much lower compared to some other individuals, some other nations in the G7. If they face that same situation here in the United States, imagine the midterms 18 months from now. Imagine the local politics and the support for those data centers. What's that going to look like? You tell me.
Governor of Virginia on 14% lift in energy costs.
You're going to want that data center? How many people they're hiring?
Yeah.
I know what it's doing to electricity prices. How many people they're hiring? Not many. It's pretty Labour light. Matt Lazzetti at Deutsche Bank. Matt, thank you, sir. Always good to hear from you. Matt Lazzetti there of Deutsche Bank, breaking things down, called correctly the end of QT. That's exactly what we got about 27 minutes ago. Bob Michael, you're fantastic at this. Going into the news conference, questions for Chairman Powell. What would you like Mike McKee to ask in a moment?
I think he's got to press them on what are they seeing from their own sources of data? What are they seeing from the regional banks and their thousands of economists? They're talking to businesses every day. They didn't make this decision blind, much as it creates a wonderful narrative for the three of us. They reacted to something. What was that?
What do you think the next decision hinges on? What are the metrics? If we don't have the data, let's say the government's still shut down, what's the next decision hinge on?
I think it's going to be anecdotal evidence from businesses. If they're still in a pause, hire, and fire, doing neither, then this Fed will respond by cutting rates 25 basis points.
What is your shop's 12-month call on 10-year yield? We're now, I'm going to say, a 399, 398. John's in charge of that. I just look at the Dow Jones Industrial Average. John looks at all the rest of the data. But on the 10-year yield at a 399, what's your call 12 months out?
Well, let's start with Fed funds. We see that around 3 3/8%. I think you're going to see the 10-year somewhere around 3 3/4%.
Okay.
Bob Michael, JP Morgan, this was fun. It's good to see you.
Always a pleasure.
Thanks for dropping by.
Great.
We've said a few times on this program over the last few meetings that these meetings are going to get harder and harder for this Federal Reserve. At the next meeting, when Chairman Powell convenes things, think about things. Today, the good news, no forecasts. Imagine how difficult it would be to provide forecasts in a moment like this. At the next meeting, can't escape it. This committee will have to put together forecasts for 2026 with the potential of not having any data at all. And even if they have the data, that data could be very, very messy. On top of that, Tom, we might have that shared decision from this administration, which will take away the ability to guide into 2026 anyway.
On this Wednesday, all this talk here as we go to this conversation, the questions and the answers, we have to remember that in, an hour and a half, these mega companies are going to show profit and cash flow that is not in any of our textbooks.
This is why, Tom, so many people right now are so bullish. What matters to the equity market? Not payrolls. I've said a few times, if I told you the payrolls data at the start of this year, at the start of 2025, you would have been hopelessly bearish on this market.
Correct.
What's mattered to equities has been earnings. What's mattered to the man that's about to step into that room is the step down in payrolls. So the market gets the best of both worlds, gets the earnings one and gets the interest rates reduction as well, two. And the man who's about to step into the room is going to deliver potentially another 25 basis point cut at the end of the year. That's the reason why so many people right now have been bullish this equity market. Equities into this news conference at all-time highs on the S&P 500 up by 0.2%. The FOMC divided, voting to cut interest rates by 25 basis points. Here's the chairman of the Federal Reserve.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire. I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor, I don't think, for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened. Some things have been happening for some time now, showing a gradual tightening in money market conditions. Really, in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings. And we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market. And the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or a material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances, and so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop at the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long, but at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation, but we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments, but so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths. And so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case, and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our job. So that's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up, in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully. And yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are. If you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data, as the reason December is not a foregone conclusion, what other things could be the concern then? Well, the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether, in fact, the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views. So on that division, then, you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risks? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle
something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes, and I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are two things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's two things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on. But it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand? And I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to zero. So maximum employment doesn't, on a sustainable basis, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. But others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American households, consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level, and then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized. While some households are clearly under stress, in the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring, and that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these are ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. It's the investment we're getting in equipment and all those things that go into creating data centers and feeding the AI. It's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that, and has been growing and has defied a lot of negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher end consumers, or maybe skewed that way, but the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You can point to growth. I mean, actually, you may be growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But, you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed. But you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies. And I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims, are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up. But job creation is very low, and the job finding rate for people who are unemployed is very low. but the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular
that we're
section
thinking
of
of
the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney.
Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. And the way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and, as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions, but we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
That wraps up the news conference from Chairman Powell following a decision to reduce interest rates by 25 basis points. Credit to that reporter and to Mike McKee for actually asking about financial conditions and financial markets. If you are just joining us, welcome to the program. Equities recovering. There was a drop-off as soon as Chairman Powell started to speak. We're back to about negative 0.2% on the S&P. The bigger losses on the Russell, the small caps down by 0.8. In the bond market, off the back of these comments from Chairman Powell, bond yields higher at the front end of the curve by 9 to 10 basis points. A 25 basis point reduction from the Federal Reserve, two-way descent, the limited ability to guide from here, and these comments from the chairman of the Federal Reserve. Take a listen.
A further reduction in the policy rate at the December meeting is not a foregone conclusion. At a time when we have tension between our two goals, we have strong views across the committee, and as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
A December rate cut is far from a foregone conclusion. That was a prepared remark. It was scripted. TK, it was heavy with intent.
I love when they look down at the script. I mean, you wonder what percentage of the press conferences.
I think, to be honest with you, Tom, it gave it extra meaning. That was
absolutely.
The intent, to come into this room and tell everybody, including Wall Street, we're not making a call on December.
Calm down, we're way down. And when we get to Torsten's Slack, I want to really dive into that. I need to frame this, John. I think it's so important. We've had this spectacular move lower in the 10-year yield down to 3.9 whatever. OMG, we've come back 4.05% at 7-8 beeps move. It's only center tendency on 2 standard deviations. We're by no means. Price has not cratered in the last 20 minutes.
Low end of the range for the year still.
Yeah.
Totally with you. Bond market's been super well behaved. When the Fed last met back in September, 2s were near 350, 10s were near 4%. Right now, TK, 2s near 360. Yeah. 10's near 4%.
There's going to be a lot of hyperventilation about this tomorrow. I'm also looking at the currency market, which I think is extraordinary, into the Trump-Xi meeting. And, it's a side story. I get it. It's not the Fed decides. It's maybe the president decides on trade. But it's a backstory to this that will be interesting the next couple days.
Dollar strength this afternoon. Euro dollar 115.82. Euro dollar down by 0.6%. TK mentioned it. Torsten Slock of Apollo with us around the table. Torsten, good afternoon. Good to see you. What's the big takeaway for you from that?
Well, that they do have clarity on the CPI, on the inflation side, but there was a lot of questions about the labor market, and it was very clear that he came into this saying the labor market is still chugging along, moving sideways, slightly cooling. And he didn't mention any of the private sector indicators. So he did basically say, we don't quite know exactly what's happening in the labor market, but we still feel quite good about it. So that's why he came to the conclusion, inflation is too high, the labor market is still okay. Therefore, there is no foregone conclusion about December.
How difficult is it to carry on cutting interest rates?
It is very difficult because the labor market does have a number of indicators that are very important for this discussion. There is, of course, ADP, which we just got, and thankfully now it's weekly. If you just think about the number, 14,000 was the average weekly number for the last 4 weeks. If you multiply that by 4, you get some estimate of what that means on a monthly basis. That means that monthly job growth at the moment is in round numbers around 50,000. We just got a Fed paper a few weeks ago saying that the new equilibrium rate for non-farm payrolls is 30,000. So by that measure, the labor market is actually strong. In other words, job growth is stronger than what the Fed itself thinks that it should be in the long run, because 50 is higher than 30. And the conclusion therefore is, now you suddenly have that both the labor market is actually doing a little bit better than expected, and inflation is still at 3, which of course makes it very difficult for them to begin cutting again in December.
Let me follow up on that, though. Is that politically acceptable to have a mid-100,000 number, 30, 40, 50,000? There's no way that plays in Washington.
Well, at least the Dallas Fed, who produced the number, had some very good arguments for that. There were 2 reasons why the equilibrium rate had gone down from 200,000 last year to only 30,000 today, which was immigration has been slowing down significantly, and the demographic headwinds also weighing on the overall number.
This is so important, and with your heritage, I think it really works out. What is the level or the new of their ex post right now? To me, they're almost redefining a way. Did you hear forward guidance in the press conference? I don't think that.
Forward guidance.
I don't think that.
In this environment.
Maybe backward guidance is the new phrase. Okay, paint the character, Dr. Slock, of our ex post nature now.
Well, the challenge also is not only did they not only mention forward guidance, but also he didn't talk about data dependent, because there is not much data. And if you say data dependent, that means that they're putting a lot of data on the private sector data. And he didn't mention some of the private sector data that actually is very important for the labor market. Not only ADP, there's also the, of course, Challenger Gray and Christmas job cut announcements. There's also a new data from Macro Edge that also looks at job cuts.
John, and you love ISM.
There is also the ISM data that still says that the labor market is okay. There's also link up job openings. There's also Indeed job openings. There's also Paychecks, which is also looking at employment. All these indicators combined still tell a story of the labor market actually still hanging in there. So it's not the case that the labor market is falling out of bed. It's still the case that the labor market is okay. And combined with inflation at 3, remember the Fed's target is 2. So inflation is still way above the Fed's target. There is just not room to cut rates more, in particular not, as he also talked about, if you begin to worry about if inflation expectations begin to become entrenched.
Torsten, what you're saying begs an obvious question. What I'm hearing from you is we've seen a step down in payrolls growth. We haven't seen an increase in labour market slack. Inflation is running at 3. Unemployment's still close to 4. GDP's tracking around 3% at the moment in this country. If that's the case, why did they just cut interest rates?
Well, his argument was also very, very carefully articulated, namely that we are trying to get closer to our star. So it's back to this, peculiar interest in that there is some very academic Kalman filter you can do and figure out where is the level of interest rates where we should be, and say this was recalibrating monetary policy to that level. It really is a very, arm-wavy and academic discussion relative to what the actual data that you just listed. And if you add also the Atlanta Fed GDP now, almost 4% for last quarter. Where are we in terms of thinking about this slowdown? There is just not much sign of a slowdown when it comes to the real
Please forgive the snark, but the way they talk about things like neutral and R-star, do these lights start flashing off in the FOMC room, in the boardroom at the Federal Reserve? You've hit it. Well done, guys. Stop right there. What are they actually looking at to guide that decision?
Well, I do think that there is an intellectual camaraderie around our star of saying, yeah, I know what you mean when you talk about our star, and of course we got to get down to our star. But the interesting thing about also this is that if you really are saying at the Dallas Fed that there is now a 30,000 non-farm payroll level, that actually means that our star is actually lower.
John, Greg Ip has been wonderful about this. Where in God's name is the output gap right now with Meta here in 25, 35 minutes, at Google, what we see tomorrow with Apple, Microsoft, the speech that NVIDIA gave the other day? Are you kidding me? We have no clue where the American output gap is.
Well, and that's why from a monetary policy perspective, it is really interesting, because if you look at the Magnificent Seven, they are all financed by equity prices being high. They're not sensitive to the Fed funds rate, whereas the S&P 493 is is very sensitive to the Fed funds rate.
Is Apollo Global Management part of the Magnificent Seven?
They should be. They should be. Mike McKee was in the room. He was in the news conference. And Mike McKee, thank you for asking about financial conditions and financial markets. Mike McKee, what was the takeaway for you, sir?
Well, I think the absolute takeaway is that the Fed is probably going to pause in December unless there's some data that forces them to do another cut. There was a sort of almost Freudian slip by the chairman close to the end of the news conference when he said, if we cut again. And then he quickly backtracked and said, we will at some point. But I think that the mood of the committee now is we've done enough, let's sit back and see what happens, especially without any data. And given the fact that inflation is still rising, you noted at the beginning when he was giving us the rundown of the economy, he said extrapolating the CPI into PCE suggests that it rose at 2.8%. Well, it was 2.7% in the prior reading. So it just shows you that inflation is still rising at a time when he had a hard time making a case that unemployment is a real problem. So I think the takeaway is don't expect much from the Fed in December unless the government gets back to work and we get some data that change their mind.
Michael McKee, you have covered the Federal Reserve for decades. Volcker through Greenspan, Bernanke, Yellen, the likes of Chairman Powell. Mike, is the era of almighty Fed chair dominance and power on the committee, has it come to a close?
Well, I think that's another way of saying that I'm old, John, but I don't think it's come to a close. It's just changed a lot. When you had Paul Volcker, he was very firm in what he wanted to do, but he came in during a crisis, so he was able to marshal the troops to do that, and then they rebelled against him. Greenspan did it differently. He ran the Fed as if it were his own, and they did what basically he wanted them to do. But starting with Ben Bernanke and following with Janet Yellen and Jay Powell, it's become much more collegial. And the chair now is more in a situation where they are taking the temperature of everyone there and trying to figure out what the best consensus move would be. And I suspect that that's what members of the board and the Open Market Committee would like to see happen going forward. Don't know, given the names of various people who are among the finalists to replace Jay Powell, whether we would have an attempt to go back to the strong chairman view or whether we would still continue with consensus.
Can they wrestle control from that committee? Mike, thank you, sir. Fantastic work. You're not old. You're brilliant. Mike McKee there in Washington, D.C. Appreciate it. You're brilliant too, TK. You know there's love. Come on, there's enough love to go. But yes, maybe a little bit. More than me. Torsten, you're still with us. Torsten's Lock of Apollo, by the way, if you're just joining us. Torsten, Bob Michael of JP Morgan was on the programme with me and TK earlier on this afternoon, and he made the case, after this decision dropped and we saw the two-way dissent, that the chairman was losing grip of this committee. What's your take on that?
Well, it is a very unusual situation to have someone on the committee that thinks that rates should have been on hold, meaning that it go in other direction than other members here, in this case, Steve Miran, who thought that they should have been cutting. So it is a very challenging environment, of course, for whoever is the Fed chair and whoever walks in to be the next Fed chair to try to get a consensus on the committee. There is so much work that goes into, from the chair, whoever it is, to try to get a decision that is unanimous and that is a common ground and saying this is the way we're walking and this is the direction we're traveling. Now that there's more uncertainty about this, one reason why rates are going up is also because, well, maybe now Schmidt is not the only dissent. Maybe there are others that come around next time and say, well, maybe we shouldn't be cutting, or maybe there might even be someone who says maybe we should be hiking. So that's why I do think there was already a dot in the dot plot last time that said that rates should be going higher in December.
I think we know whose dot that was.
And now we know that that was Schmidt from the Kansas City Fed. So yes, it is becoming a much more challenging exercise. Normally, we just talk about inflation, unemployment, but this is no longer just about inflation, unemployment.
The heart of this, we got to get to Rosenberg, but the heart of this, John, is he's lame duck. That's all there is to it.
Totally agree, TK.
It's October. He's supposed to begin to be lame duck.
So let's fast forward to December. Just think about for a moment how much harder that's going to be. Put out forecasts, probably know who the new Fed chair is. How much power is Chairman Powell going to have at the December meeting, knowing who his replacement is potentially once we come around to May?
Yeah, I agree. And of course, as we've said 3-4 times today, not me, but others are saying the Secretary of Treasury could be involved as well.
Jeff Rosenberg of BlackRock's running. Jeff, welcome to the program. I won't mention Rick. We'll leave that to one side. We'll keep you in, good company over at BlackRock, keep you out of trouble. What about it? No, Jeff, seriously.
Right.
Jeff Rosenberg, number one takeaway from that decision this afternoon and that news conference too.
Yeah, I mean, the number one takeaway is the comments on December, the comment on slow down when you're driving in the fog. It's interesting you guys were picking up on him reading in the notes and whether that was, very much pre-planned. I think what you see here is a repricing of market pricing to December. Going into this meeting, it was basically a foregone conclusion. It was 100%. When you come out of the meeting and you see the dissents on both sides and you recall the division within the committee, you could say that is an appropriate repricing to the realization that there's more two-sided risks to the Fed's decision than the market was pricing in. And perhaps that comment was engineered to kind of push that forward. Maybe it wasn't, but the reality is that's what the market reaction is. And you can see that that's, a very reasonable reaction to what we saw from the committee today.
I'm going to do an audible here. We got Torsten Slok and Jeffrey Rosenberg with us, and that is good and wonderful with their financial and economic knowledge. Torsten, you have a blistering sentence in your note of your concerns over private credit. I would suggest for global Wall Street, into the next Fed meeting and beyond, there's going to be further challenges here about the opaqueness in private credit. With all of your resources at Apollo Global Management, how blind are we to where we're heading in the pricing of private credit?
That discussion is totally misguided. In public markets, I can get something that's safe, I can get something that's risky. In private markets, I can get something that's safe, I can get something that's risky. So there is no difference. It really is all about, do you want a risky investment? Do you want a safe investment? Something in the public market is investment grade, something in the private market is investment grade. So this discussion around what's happened in the last few weeks, yes, there might be a few cockroaches in the sense that there have certainly been some things that have been going under. But interestingly enough, those were basically all broadly syndicated loans, meaning these were things that were trading tick by tick, minute by minute in the public market. So why is the discussion about what's happening in private credit relevant for this? These were cockroaches in the public market that showed up in public balance sheets.
Jeff Rosenberg, will this affect the Fed? I mean, it's just as simple as that. If we have Wall Street instability and fear about this with all your work at Carnegie Mellon, can they ignore those cockroaches?
Well, it gets back to some of the earlier comments about, the questions that he got on financial conditions.
Yes.
And, to what extent does financial conditions sort of factor into the Fed's decision? And I think what we see is an asymmetry here, that financial conditions aren't really factoring into their decisions to cut rates here. Financial conditions, you saw him parry the questions around interest rates and AI, basically, brushing them aside, saying AI financing has nothing to do with rates, which is true on a first-order effect, but not necessarily on the second order effect, to the extent that interest rates broadly are creating very easy financial conditions, and they're contributing to the increase in financial conditions easing, especially that we saw since the Fed pivoted, to the labor market slowdown. That took us from, measurements that were sort of more optimistic to measurements that were kind of more on the euphoria side. But I think the asymmetry here is that the Fed will respond to tightening financial conditions after they're realized. To the earlier, interchange on, ex post and data dependence, this is a Fed that will be reactive. And I think what's very clear is the Fed's not really paying a lot of attention to financial conditions going into this cycle, but they will, as they have been, ever since the GFC, that they'll be very responsive if financial conditions for things that have nothing to do with the Fed end up tightening. The Fed will react into that with a massive cut in interest rates, restoration of zero interest rates, the forward guidance that you just talked about, balance sheet, all the tools that were once thought as kind of not normal are part of the normal playbook, but they'll be in reaction to something that is outside the Fed's control here and in a tightening of financial conditions.
Jeff, is that still a green light then? A bright green light just to stay long risk, stay long equities?
Well, it's a light that says you can't really predict that on a directional basis. The Fed is supportive here. That's part of, again, what we saw in kind of the movement in the metrics from optimism to euphoria around August, September. And the Fed's continuing to send that signal with market pricing coming down a bit, but basically pricing to normalization of 3%. And the expectation that under any circumstance where the Fed is faced with an outsize. And you heard in that last question right at the end, the Fed talking about the impact on consumption. This is understated. I mean, he said it in a very small way, but a large shock downward has a significant effect on consumption. And what was a little bit understated here is that the large increase in the wealth effect has been the support for consumption. It is why we're surprisingly strong. In addition to the lagged implementation and tariff inflation not being as worrisome, it was really the surge in the wealth effect and consumption that's leading to the upside surprise. But that has a double-edged sword to a larger decline. And that's, I think, the concern around financial conditions tightening.
Jeff, before you go, I promised I wouldn't mention Rick, but I think it's worth it. I've known Rick a long time. You've worked with him a long time. Can we just spend a second or something? Just how cool is it that Rick Rieder's name is associated with the Fed chair position?
It is very good for you to talk about that, and I look forward to hearing more from you on that subject, Jonathan.
Okay, Jeff Rosenberg of BlackRock. You avoid it, Jeff. You avoid it. I think it's fantastic.
I did.
To have someone like that.
To have the mix, absolutely.
It just makes the process all the more credible, which I imagine was the objective of the Treasury Secretary.
Mr. Rieder brings an entrepreneurial sense here that you don't get from grizzled economists. And
understands
the
this market.
president is to be hugely lauded for that with his secretary. Can I point out in the time we've got left something back to the late July meeting?
Sure.
Google, who we're going to hear from in 45 minutes, is up 42%.
Not bad.
We have to remember, I'm talking about the food lines in Chicago with Diane Swang. The roulette wheel is in full spin right now.
We've got about 60 seconds left. Programs like these traditionally obsess over what can go wrong. Torsten Slot, can we finish on what can go right? You put out a fantastic note in the last month about the economics profession needing to take a long, hard look in the mirror and just think about where we are compared to where they thought we would be, which is in a much worse place.
Absolutely. So the key issue was that Liberation Day is now 7 months ago, and we are still having a Fed chair that talks about the labor market is actually doing quite well, and we still have inflation above the target. I think that we have all been surprised, and of course the market has been surprised, and the economics profession has definitely been very surprised that the textbook would have predicted a much more stagflationary shock, much more upside pressure on inflation, much more downside pressure on GDP. We have not seen that, and some would say yet, but this is the discussion, namely, do we still have that, as you just said, as a lagged effect in front of us, or is this it? And then things are only getting better for here. And this is why what the Fed was doing today was exactly to say, so far, we have not seen that stagflationary shock that we expected in April after Liberation Day.
TK, we've been saying yet, it's not happened yet, for a long time now, a number of years.
We got to get the shutdown finished so we can get the data, because we're all blind. That's the number one thing.
Right now, we're waiting for earnings. An interesting meeting in the last hour or so. Torsten Slot of Apollo. Torsten, thank you, sir. The Federal Reserve reducing interest rates by 25 basis points. Dissent to both sides, and a very, very limited ability to guide beyond this meeting into December. Equities attempted to turn around. The opening bell behind us, the closing bell 15 minutes away, and a ton of earnings still to come. From New York City, good afternoon.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:46 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We've got 14 minutes to go ahead of the closing bell. 14 minutes until a slew of closely watched tech earnings. We're going to be all over those numbers as they break. The Dow, the S&P lower, NASDAQ higher. NASDAQ 100 index also advancing, but stocks slumped as the Fed cut rates by a quarter point for a second time, but downplayed the prospect of further reductions before the end of this year. Here's Fed Chair Jay Powell. You heard him live right here on Bloomberg.
In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1.
Evidence of division at the Fed over the future of monetary policy sent stocks down for the first time in 5 days and pushed bond yields higher. 10-year 4.06% with a 2-year 3.60%. S&P down 13, dropped there of 0.2%. The Dow down 160, a decline of 0.3%. Again, the S&P down 0.2. Nasdaq right now up 0.3%. Spot gold down $15 the ounce, now down 0.4%, $39.37. West Texas Intermediate crude up 0.3 to $60.33 a barrel, and Bitcoin down 2.1%, 110,500 on Bitcoin. Nvidia holding on to gains after breaching $5 trillion in market cap. Nvidia up now by 2.9%. Coming up after the close of trading, we'll be hearing from Alphabet, Meta Platforms, and Microsoft. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I've been driving all night, my hands wet on the wheel.
Come on, let's take a drive.
A drive?
Yeah, a drive.
Can you just focus on driving? Focus on the road.
Driving in your car.
Why would I drive fast?
Because I'm asking you to.
Just take your place in the driver's seat.
Just drive, baby.
Driver's seat.
This is the drive to the close.
But we're going, we don't need roads.
On Bloomberg Radio.
Ah, yes, indeed, everybody. On this Fed Wednesday, we are driving to the close. Good afternoon. Carol Massar, Tim Stanovic, live here at Bloomberg headquarters in our Bloomberg Interactive Brokers studio. 7th FOMC meeting of the year, one and done. Two and done, actually, where we're seeing 2 rate decreases.
I thought you were saying one more and then we're done for the year, which there is one more in December.
Listen.
And that's the headline from this.
Exactly. First of all, Jay Powell, Fed chair, saying overall it's a good picture for the economy. That to me was it in a nutshell. But for the markets, Tim, it's exactly what he had to say about the next meeting. Keep in mind, we had 2 dissents. Fed Governor Stephen Miron dissenting in favor of a larger half-point cut. And then you had Kansas City Fed President Jeff Schmidt kind of coming out of nowhere, it felt like.
Yeah, dissenting in favor of no cut at this meeting. He has been among the Fed officials who has signaled caution about the inflation outlook. But Carol, it's all about December. That prepared remark, Powell saying that December cut is far from a foregone conclusion.
Here's what he said at the presser. Okay. Well, he said a lot of things, and we're just going to walk you through some of it because he did talk about still focused on that dual mandate. Then they talked about conditions in the labor market appearing to be gradually cooling and inflation remaining somewhat elevated. But he talked a lot about inflation, too.
He said in the near term, risks to inflation are tilted to the upside, risks to employment to the downside.
All right, we've got it. It's a crazy Fed day, but here's what Fed Chair Jay Powell said at the press conference.
My colleagues and I remain squarely focused on achieving our dual mandate goals. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In the near term, risks to inflation are tilted to the upside, and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
All right, everybody, that is Fed Chair Jay Powell at today's press conference. The next Fed decision is December 10th. We should point out that initially on that December comment, markets and investors have been banking on another Fed cut come December. You did see equity markets sell off. You saw the U.S. Treasury yield curve rates move up all along. We've bounced around a little bit. Equities have settled a little bit, but we're definitely off our best levels of the session, just down about 81 points on the Dow Jones Industrial Average. But S&P, we could see another record. We're still up about 2 points. NASDAQ 100 up about 114 points. We've seen small caps in particular really taking it the most on the chin. No surprise if there's concern certainly about the outlook. That index, Tim, is down about 1%. But we should talk about the yield curve because right now we are seeing U.S. yields elevated. They have moved up and they're pretty much at their highs of the session.
Yeah, the 2-year Treasury yield up to about 3.6% as we speak. At that meeting earlier today, 3.49% is what we saw on the yield there. I'm just looking at the tick by tick, Carol, on the S&P 500. And before that comment from Jay Powell, the S&P 500 was at like 69.08 roughly. Then after that comment dipped down to about 68.56.
Yep. We've had an interesting volatile day where the markets have certainly been following the things that we got from Fed Chair Jay Powell. 10-year note right now, it is above 4%, just barely, but at 4.06. All right. Fed meeting done. Focus on the December meeting. We move on from that. But really what our focus is right now is a bunch of big tech earnings that we're going to get after the closing bell on a day when we saw Nvidia hit $5 trillion, Alphabet, Apple, and also some non-tech names like Caterpillar and Teradyne hitting all-time highs. They've been moving around as a result of what we got from the Fed chair. We've got a great voice, though, when it comes to those big tech earnings we're going to be getting after the close today.
Angelo Zeno is Senior Vice President and Equity Analyst with CFRA Research. He joins us from New York City. First up, Angelo, we got to get your thoughts on what we heard from Jay Powell just now. Not a foregone conclusion for a policy move lower in December. In the context of the companies that you cover, the big tech companies, the ones that are reporting today, the ones that are reporting tomorrow and more, what did that news mean?
I think it's a great place for big tech right now, to be honest with you. I mean, you've got challenges going on, I'd say, outside of big tech in terms of, potentially the employment side of things, in terms of, maybe uncertainties about the economy, potentially, leaves room for additional rate cuts. And that would support valuations, I'd say, on the tech side of things. But realistically, when you start thinking about big tech, most of these names, clearly have some really strong structural, secular themes going on right now, where they can really power through a lot of uncertainties from a macro perspective in whatever the Fed decides to do as far as interest rates are concerned.
Angela, we want to get into those specific companies, but just real quickly, Jay Powell, that is, asked about the AI-related spend and said, by cutting rates, might there even be more spending? And then maybe, could this lead to, a bubble, essentially? He said he didn't think these investments are particularly interest rate sensitive. Do you agree? Is that correct?
I do agree with that. Yeah. I mean, I think it's going to be, at the end of the day, I mean, these companies have, whatever, CapEx plans in place that they're going to plan. And to be honest with you, they're already making allocations today for whatever they plan to do 2 years from now in 2027. So, I don't think a change in interest rate is really going to dictate anything in terms of the plans for these mega cap tech companies, or even some of the tier 2 companies. It's really going to be dictated on what the actual, demand landscape for AI is going to look like here in the foreseeable future.
Having said that AI spend, nobody does it better than NVIDIA and hooking up relationships. $5 trillion, first company to ever do that. Justifiable in your view?
Yeah, I mean, absolutely. I hate saying this, but I mean, and I don't want to call it still cheap, but I mean, I would say at the very least, the valuations here still look very reasonable for NVIDIA. I mean, you look at what they announced just yesterday at their GTC DC event, and really that $500 billion in bookings was really eye-popping, and I think exceeded what most expectations were out there. I think consensus street estimates remain now way too low, and I think the street has caught on to it, and they're going to continue to bid up the shares here looking ahead. And again, I don't think there is any reason to think that bookings growth will slow down here in the foreseeable future, as we think you'll continue to see that momentum going right into 2027 and 28.
All right, well, before we get to 2027 and 2028, we got to get through what's going on today. And that, of course, has to do with Alphabet, Meta Platforms, and Microsoft among the companies reporting today. I'm going to let you choose where you want to go. The most important one, in your view, we need to keep an eye on, and why.
Yeah, I mean, listen, I'd say theme-wise, right, it's going to probably be, dictated more so on the cloud than it is on a digital ad side. I think, we have a good indication of what's going on in terms of, digital ad market, but I think really what's driving, some of the powering the AI investments more so than anything is what's going on in the cloud. And because of that, you need to hear from what Microsoft has to say. Azure grew, 39% here in the June quarter. Our view is you're still going to get high 30s growth here for the September quarter, and a similar guide for the December quarter. So I think really that's going to be key. I think you want to also hear what Alphabet has to say about their cloud business as well, as we're looking about 32% growth.
Hey, was the outage last week at AWS, is that an opportunity for Microsoft to get share?
It's tough to say. I mean, we're not looking at it like that, but it'll be definitely interesting to see what both Amazon and Microsoft have to say about these outages that we've just seen.
Hey, just real quickly, 30 seconds. Which of the Mag 7 are you most confident about at this point? We've got, of course, Amazon and Apple tomorrow. And forgive me, just about 30 seconds, but which one do you like or feel most confident about?
I mean, if we're going all the way across the Mag 7, we're highly confident on NVIDIA. But as far as the ones reporting here, I mean, we do like Microsoft a lot. And that's not necessarily based on this quarter. This is a company where we think they'll more than double their revenue here over the next 7 years, and it's going to be powered by that Azure business. And as a result, we think they're going to find new ways to monetize the platform, and we just overall really like this story there. It's probably our highest conviction call. But that said, it's anyone's guess on what's going to happen in any given quarter.
Come back soon. Angelo Zeno over at CFRA Research. Folks, do not go anywhere. Lots of big earnings to come. We're heading over to our TV colleagues. The closing bell starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katie Greifeld, taking you through to that closing bell with the global simulcast. Carol Masser, Tim Stenovic, they're in the radio booth. Welcome to our audiences across all of our Bloomberg platforms here on a very busy afternoon. A lot of things going on there, a potential détente in the U.S.-China trade wars, a Fed meeting that actually surprised in a rare sort of move, and of course a slew of earnings on tap just moments away.
Yeah, what an exciting day. And we've definitely seen a reset when it comes to the Treasury trade with, Jay Powell talking about the December meeting. So much was expected in terms of another rate cut come December. Angelo Zeno was just on with us. CFRA Research covers the big tech names. He says it's a great place for big tech. Even with what we got from the Fed today, he's not worried about the environment. He said there's challenges outside of big tech, and even addressed what Jay Powell was asked about in terms of the AI spend. And again, he agreed with what Jay Powell said. This area, higher rates or lower rates or whatever, not a problem.
He's also saying, hey, NVIDIA's pretty reasonably valued at $5 trillion. NVIDIA hitting a $5 trillion market cap for the first time today, of course, but
yeah, I was going to say, did he exactly say that?
He did say that.
Yeah,
he did. Still a deal.
He's blown away by the number we got from the GTC event. In
500 billion.
Yeah. So.
Yeah, there you have it.
I thought it was interesting, too. He said that, this AI spend, it's not like the 1990s tech bubble because these companies have earnings. So we should point out some of these companies have earnings. Of course, there's a lot of players in this space here that have not shown a whole lot of anything. We are going to see some of those cards put on the table in just a matter of moments. We're expecting earnings out of Meta, out of Microsoft, out of Alphabet, and that's just in the tech space. Also expecting Carvana, Starbucks, Chipotle, and a few others. As we get the closing bells here in New York, the S&P straddling the line between gains and losses. I'm just going to call it right now, unchanged on the day, but it does look like it could potentially, maybe, finish in the green or maybe not. The Dow Jones Industrial Average is decidedly down more than 70 points or 0.1%. The NASDAQ is going to finish firmly in the green, up about 130 points or 0.6%. The S&P 500, we'll call it now, it is going to end the day in the red, so no record high for that. And the Russell 2000 down another day, 0.9%.
Yeah, looking at the S&P 500, most names in that index, folks, lower today. 378 losing some ground today, Katie. 124 to the upside and 1 unchanged.
Yeah, super narrow there. Let's take a look at the sector, and let's take a look at the circle and see what our friend is saying there. You can see that tech did manage to finish in the green, actually as a sector overall up by about 1%. All eyes on NVIDIA. Communication services, which is pretty much tech in disguise, also rallying strong today. Energy industrials catching a little bit of a bid. What didn't do too well, you would guess this would be the case. Real estate down by 2.7%. We saw a big pop in yields as Jerome Powell was speaking, and that certainly hit that sector pretty hard.
All right, real quickly, NVIDIA, got to mention, $5 trillion market cap today. The stock up as much as 5.5% earlier in the day, still finishing with a gain of about 3%. Historic $5 trillion market cap. We know we got a lot of big headlines from the company and its CEO, Jensen, yesterday, just the AI spend, the AI frenzy, and we know how important this name is certainly to the bull market that we've seen. With a 50% gain this year through yesterday's close, the stock is single-handedly responsible for nearly a fifth of the S&P 500's index, 17% advance this year. So we know it's been really driving the trade. Teradyne, just got to mention, this was definitely a top gainer in the S&P 500, up 20% in today's session. I believe it's a record close. It's a semi-manufacturing company. Third quarter results beat expectations, and it gave an outlook well ahead of analyst consensus. It also named Michelle Turner its chief financial officer effective November 3rd. That stock up 40%. And Caterpillar up 11%, also an outperformer today.
Is this an AI play now, I'm told? Is Caterpillar an AI play?
No, isn't it nice? We got Alphabet. Let's
All
go
right.
there.
Well, speaking of AI, yeah, Alphabet earnings are out. EPS coming in. Looks like a pretty big beat. $2.87 a share for the most recent quarter. The street was looking for $2.26. Revenue in the most recent quarter also a beat. $102 billion in change. The street on average was looking for roughly about $99.9 billion. The company also says that it ended the quarter, that Google Cloud, I should say, ended the quarter, get this, guys, $155 billion backlog.
Oof, yeah, certainly raises the stakes, too, for Amazon. A lot of focus on that cloud business. You can see Alphabet shares deciding what to do, moving higher right now. I will say, Tim, that the bar was high for Alphabet specifically. You think about where the stock has gone year to date, up by 45%, but clearly you can see investors parsing through and deciding what to do.
Yeah, bouncing around a little bit, but firmly higher now, about 3%. Sundar Pichai, the CEO, out saying that the company had a terrific quarter, double-digit growth across every major part of the business, calling out the first ever $100 billion quarter. He also called out Gemini. It now processes 7 billion tokens per minute and alludes to the full stack approach to AI at Google that's delivering strong momentum, shipping at speed, including the global rollout of AI overviews and AI mode in search in record time. Shares now up by about, 4%.
All right, from one hyperscaler to another we go. Let's go to Microsoft, folks, just crossing with its numbers. First quarter intelligence cloud revenue, this is what we care about, $30.9 billion. The estimate on the street was $18 billion, so it looks like it's coming in line. First quarter Azure also important. Another cloud revenue, X currency, up 39%. That beats the estimate of a gain of about 37.1%. And first quarter revenue, again a beat, $77.67 billion. The estimate on the street remained $75.55 billion, and yet we're seeing the stock down about 4% here in the aftermarket. So we'll look for some more color on this one.
Yeah, some of these numbers, while certainly a beat with regards to the average of analyst estimates that were public, it looks like they did come in below some of the whisper estimates that Bloomberg had reported on. But it gets to this idea as well, and we always have to wait with Microsoft to actually get any sort of forward guidance a little bit later. But this idea of exactly what is in the pipeline that they can actually sort of deliver or at least flag to investors that could sort of be a signal here that not just the spend on Microsoft's part, but more importantly, the reciprocity is actually still there.
Yeah, absolutely. Maybe we'll get some more detail about the pipeline when it comes to the earnings call. But you can see, again, those shares holding the after-hours decline of about 4%. And we know it was a big week for Microsoft with that OpenAI restructuring. Microsoft, of course, securing a stake here when it comes to the future, at least through 2032, Tim.
All right, I'm taking a look at Starbucks, ticker SBUX. That company out with earnings as we speak. Fourth quarter China comp sales up 2%. The estimate was for 2.16%. Fourth quarter comp sales up 1%. The beat estimates of just about negative half a percentage point. Fourth quarter net revenue coming in above estimates at $9.6 billion. Fourth quarter adjusted earnings per share coming in shy of estimates at 52 cents. Fourth quarter North America comp sales, they were flat. The estimate was for a decline of half a percentage point. Fourth quarter adjusted operating margin up 9.4%. The estimate was for 10.2%, so that came in below estimates. Starbucks shares up about 1.6% now in the after hours.
All right, so let's get to Meta because we're seeing the stock drop about 3.9% here in the aftermarket. Meta, with the outlook, sees fourth quarter revenue 56 to 59 billion. The estimate on the street is 57.38 billion. Fourth quarter 2025, or fourth quarter revenue. Let me go there because we're red heading that one here at the Bloomberg. Meta seeing fourth quarter revenue 56 to 59 billion, estimate 57.38 billion. Again, the stock down about 5%. Sees fourth quarter total revenue to be in the range, again, of 56.59. I keep rereading the same ones as they come up. Looking at the past quarter, third quarter ad revenue was $50 billion. That's a beat. The street was looking for $48.59 billion. Third quarter EPS, $1.05 versus $6.03 a share. That's year over year. So we'll look for some color on that one. And then just looking at, go ahead, Remy.
I just also want to point out too here, just going through the release here, there does appear to be a pretty large charge that the company took in the most recent quarter. This is a non-cash income tax charge of $15.93 billion. Meta, though, does say this is a one-off event, and I just want to be very precise in the language here, and that they do still see their fourth quarter 2025 tax rate in the range of 12 to 15%, which would be in line with what the street was looking for. But that does appear to be where we're getting some of the reaction, and one of the reasons why you did see a little bit of softness in that bottom line number for the quarter that just was. Let me just dive a little bit deeper into it and try to get you some more details.
Yeah, we'll continue to follow that, but as Romain said, could explain some of the negative reaction that we're seeing right now. Meta shares now down by more than 7%. I do want to go to this line in the release. We have a lot of focus, of course, when it comes to CapEx. Meta, they expect full year 2025 total expenses to now be in the range of 116 to 118 billion. The prior outlook had been for 114 to 118 billion there. And they also say that our current expectation is that capital expenditures dollar growth will be notably larger in 2026 than in 2025. This has really been the story for a lot of these big seven names, but also for Meta particularly.
Sorry, I do want to go back to that tax issue here with Meta, and this is something that Zuckerberg and his team are going to have to address on the call. They talk about the one big beautiful bill, basically the big budget stimulus that was passed earlier this year. They did say that they expect a significant reduction in their federal cash tax payments for the rest of the year because of that bill. However, they're saying that for the quarter that just passed, they had to recognize a valuation allowance change that basically amounted to a $16 billion charge. Again, they are saying that this is a one-time charge, and then effectively they will revert back to something actually a little bit less with regards to the effective tax rate for the current quarter, the current fourth quarter that we're in.
Yeah, the company continues on there. Romain says net income would have increased by $15.93 billion to $18.64 billion compared to the reported net income of $2.71 billion. The company also saying, Mark Zuckerberg specifically saying that leading the industry when it comes to AI glasses, which we know that, and he sees a big opportunity there. A lot of analysts see a big opportunity there. He says if we deliver even a fraction of the opportunity ahead, then the next few years will be the most exciting period in our history.
All right, well, those are some big words, but let's tear our eyes away from Meta for just a moment and talk about eBay, also reporting earnings. Fourth quarter net revenue, that is seen between $2.83 billion to $2.89 billion. The estimate had been for $2.8 billion. So a bump up of that range. Take a look at shares down almost 9% at this point, though. So certainly some disappointment coming through when it comes to eBay.
Some disappointment as well when it comes to Carvana. Those shares down 10% in the after hours trade, with third quarter EPS coming in at $1.03 a share, revenue coming in at $5.65 billion. But here's your guidance. The company says that full year EBITDA will be at least $2.2 billion. It had previously pretty much guided towards that. It had a range of $2 to $2.2 billion, so maybe potentially trying to nudge slightly above that with regards to expectations. We should point out, though, the company is also saying here with regards to retail unit sales, 155,941. We'll just round up to 156,000 here. Again, that did beat the average of analyst estimates, but there was a whisper number out there that was a little bit higher, maybe partly responsible for why you're seeing the shares down in the after hours trade.
Yeah, costs and expenses too up about 32% year over year. Kurt Wagner, though, on our live blog talking about this net income and how we see this shortage and then attributing it to this one-time tax charge. Definitely a lot of questions on what this is, because it does feel like it's come out of nowhere.
Sorry, one quick one. Chipotle crossing the wire right now. Adjusted EPS coming in line with estimates at 29 cents a share. Revenue roughly coming in line with estimates at $3 billion. Comp sales lower than estimated, coming in at 0.3%. The street was looking for a gain of about 1% here. So a little bit light with regards to comp sales growth. Also a little bit light when it comes to operating margin, 15.9%. The street was looking for 16.6.
And while we're here, let's just talk about ServiceNow really quickly. Boosting their full-year subscription revenue forecast, also beating estimates when it comes to the look-back. Subscription revenue now seen between $12.84 billion to $12.85 billion. The previous guide was for $12.78 billion to $12.8 billion. So you can see, of course, a little bit of a boost there to ServiceNow when it comes to that full-year subscription revenue.
All right, so Microsoft down 3.3%. You've got Alphabet up about 3.5%, and you've got Meta down about 5.7%. So those are big ones that we'll keep a watch on as we go into those calls with analysts and investors. Folks, that's a wrap. Across platform, radio, TV, YouTube, Bloomberg Originals, Katie and Romaine continuing there on the close on BTV. And right here on radio, Tim and I continuing on Bloomberg Business Week Daily as we continue to digest this earnings drop on this Fed Wednesday. We'll see you again, same time, same place tomorrow.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody, we continue on this Wednesday. Big drop of earnings, as we mentioned. Really, three of the Mag 7 reporting. You've got Microsoft down about 3.5%. Let's just round it up here. You've got Alphabet. It is up about 4%. So pressure on Microsoft, a rally in Alphabet. And then you've got Meta right now. It is dropping in a big way. Tim, we've got that, down about 6% here.
Yeah, so long-term, Meta says it expects a significant reduction in our U.S. federal cash tax payments for the remainder of 2025 and future years due to the implementation of the One Big Beautiful Bill Act. But they reported net income of just $2.71 billion. That was a huge drop from last year. The company says that number would have actually been $18.64 billion if not for a one-time non-cash income tax charge of $15.93 billion. I want to know.
I don't understand it.
So, well, it's a one-time charge.
I get that.
They're paying it now.
Okay.
It reduces net income to something that looks way below what everybody thought it would be.
What is this charge, though?
That's a question that we're going to have to ask Ivan Feinseth, and why investors were not expecting this.
Because it's not like taxes changed from the year before.
And why is Meta the company that has this hit and not these other companies?
That's what I'm saying. Like, I understand the big, beautiful,
Bill Act
is going to change their tax situation going forward.
But why the one-time hit right now?
But exactly. What changed from the previous year that we're seeing all of this? So
and they were very clear. It seemed like they wanted to be very clear in their communication. There was like this paragraph devoted to this in the earnings release, just below Mark Zuckerberg's commentary.
Right.
The street is not buying that right now.
I will also say that, our Kurt Wagner's pointing out, here we go from the release, our current expectation is that capital expenditures dollar growth will be notably larger in 2026 than 2025. I have to say that was one of the things I was looking at in terms of their expenses and so on have gone up about 32% year over year. And if they're looking at spending even more, maybe there are some concerns again about the spend, the AI spend, which many say you need. You got to get ahead of all of this to meet the demand, but will that ultimately pay off?
Yeah, and let's put some numbers there. $66 billion to $72 billion as of June. That was the 2025 CapEx guidance for the year. Things have tightened a little bit to $70 billion to $72 billion. It's coming in at the high end of the original range, but if that's what it's going to be for this year, and then the company says CapEx dollar growth will be notably larger in 26 than in 25.
Right.
How much bigger than $70 to $72 billion is it going to be?
Exactly. Plays to the spend. I will point out third quarter ad revenue. That was a beat, $50 billion versus the estimate of $48.59 billion. If you recall, last quarter, we got to this and we saw how the company was monetizing the AI spend. So there are still some more questions to be known. Again, I'm just going to pull up Meta here in the aftermarket, folks. It's down about 6.6%. Let's also talk about Microsoft, because this one also under pressure, Tim. It's down about 3.5%.
Yeah, first quarter revenue did beat estimates. Microsoft reported revenue for the first quarter, or Azure and other cloud services revenue, ex FX for the first quarter that beat the average analyst estimate. Here's some numbers. $77.67 billion, that beat estimates of $75.55 billion. That was for the first quarter. Earnings per share came in at $3.72. Operating income came in above estimates at $37.96 billion. That beat estimates, Carol, of $35.1 billion.
All right, let's see if the growth rates, though, is what, or it just seems like the investors are a little disappointed. As we said, the stock down 3.5% here in the aftermarket. What?
The guidance on the call. guidance on the call.
Yeah, that's true, right? And we'll find out the outlook. This stock, keep in mind, is up almost 30% year to date here in 2025. Let's head out to our Chicago News Bureau. That's where we find Bloomberg Intelligence Senior Technology Analyst Anurag Rana. Anurag, we wanted to give you a little time to stew over this. Walk us through what we've got so far from Microsoft, because investors seem a little disappointed.
Yeah, I mean, I don't really find a whole lot of mistakes in these numbers. And you look at Azure growth of 39%. I mean, given that size, that's pretty good. The margins actually stood out way higher than what we were anticipating. We thought there was going to be pressure on margins because of all the spending. And then lastly, when you look at the capex number, substantially higher than the 30 billion that they talked about. Now, to some people, maybe that's a disappointment, but for us, that's a good thing because I think they have so much demand coming in. They're going to add more capacity this year, and that's something that we have been saying for a while.
I'll ask you the same question that I asked Angelo Zeno a little earlier, and maybe it's too early to tell. Maybe we won't hear anything about it on the call, but the cloud race between the three biggest providers out there, AWS, Azure, Google Cloud, is there an opportunity for Azure to get market share from companies that might have been affected by last week's AWS outage? Is that an opportunity?
Well, typically I would say no, because they are facing the same problem today, frankly. So when you look at some of these large install bases, it's very difficult to change your applications. But what is the big opportunity, not just for Amazon or not just for Microsoft, but for all of them, including Oracle, is most companies eventually will have a backup cloud provider. They don't have it right now, but that is going to be one of the bigger growth drivers down the road after the AI boom is done. So I mean, from our side, the market is big enough for all of them to prosper very, very well in the coming years.
I mean, Anurag, as you said, the Azure Cloud Computing Unit posted a 39% revenue gain in the quarter when adjusting for currency fluctuations. That did beat the street estimate of 37%. I'm reading some, analysis that says, well, that was a disappointed. The expectations were high. What was there a whisper number in terms of growth on the street?
No, the consensus was 37. This is what the company said. Okay. Now, if you really want to dissect it, badly, then you could say, well, Google Cloud growth accelerated in the quarter compared to the previous quarter. For Microsoft, it was 39. It's still at 39. But there are different bases. That one's, Microsoft is running at about 75 to $80 billion in annual run rate. Google Cloud is still at 30%, and yet Azure growth is higher than Google's cloud growth. So I think people are probably just splitting hairs at this point.
Yeah, and you referenced that when you were answering my question, you referenced the outage that Microsoft has having right now, this global Microsoft outage. So we should note that, just cloud companies are cloud companies, and sometimes it's AWS that has the outage, sometimes it's Microsoft that has the outage. Hey, the OpenAI question. We talked a lot about this with you yesterday, and I imagine that on the call, investors will have a lot of questions about, okay, this close to 30% ownership of OpenAI, the parent company of ChatGPT. What is that going to do for Microsoft?
See, I think from our side, the equity part is not what, for our concern. It's really the technology that Microsoft is holding on to. That's really the critical piece because, one of the ways we think about is they will sell more products. They will sell more cloud services using that technology than they would just on the, share side of it. And that's a bigger thing for us because they have, a hold of that for the next 7 years.
Hey, one of the things I want to ask you, and I know this isn't typically your coverage, but you're smart and you cover all things technology. But Meta down almost 8% here in the aftermarket. As you see this, what's this one-time tax charge? I guess we're still trying to figure this out. But is it all about that, or is it just that we were caught off guard?
See, I think that could be a lot of the noise than the number, and I'm very sure they're going to give clarity on that. But the big question or the overhang on Meta always is, how are you monetizing AI? You're spending all this money. Where is the revenue you show for it? I think that's where management really needs to give and address that in a much more succinct way than they have. The other side is they don't have a cloud platform, just like Google does or Amazon does or Microsoft does. So Meta is the one that needs to explain these things far better than, frankly, the other three.
I want to bring in Ivan Feinseth, Research Director and Chief Investment Officer with Tigris Financial Partners, got over $500 million in assets under management, and pose that same question to him about Meta Platforms. The company saying that the implementation of the One Big Beautiful Bill Act led to the recognition of a valuation allowance against our U.S. federal deferred tax assets, reflecting the impact of the U.S. corporate alternative minimum tax, the result of one-time non-cash income tax charge of $15.93 billion. Shares, Carol, down 7.8%. Ivan, you've had some time to dig into this a little bit on the Meta Platform side. What's going on here?
Well, all right, so the big beautiful bill caused the recognition of a deferred tax asset. It's actually a non-cash charge, and while it caused a spike in their tax rate to 87% for the quarter, it actually goes down significantly going forward. I think this is really a non-event. It's an accounting issue, and I think any weakness is a buying opportunity in the stock because there's so many positive long-term trends that will continue to drive the stock higher.
But is that why the stock is down right now, because of this one-time charge affecting the bottom line? Is that the concern, or is it what Carol brought up, the idea of CapEx going up next year?
And the spend.
Well, no, we have seen investors make a mistake consistently in selling Meta platforms on capital investment increases. They continue to invest in driving their AI capabilities, which drives increased user engagement. It drives increased return on ad spend investment. So I like when they continue to invest. And we've seen this multiple times. If you listen to what Mark Zuckerberg does every time he invests from the beginning, from changing the company from Facebook to Meta, and when he was investing in mobile, the stock sold off. Now, most of the people engaging in Facebook and Instagram do it on their phones. So you have to listen to him. He says what he does, and he does what he says, and he continues to create value. So on any weakness over the increase in CapEx, and again, this is positive because there's been a fear that we're going to see this AI bubble burst, that companies are not going to continue to invest. We've seen all three companies reporting today, Alphabet, Microsoft, and Meta, all increasing capital investment in AI development, and that's positive for the companies, those three companies, and it's positive for the bullish AI investment theme.
You know, this 15% corporate alternative minimum tax, yeah, I'm Googling some stuff here, folks, because I want to understand it. It came out of the Inflation Reduction Act of 2022, and it generally applies, I think, to corporations with an average annual adjusted financial statement income exceeding $1 billion over 3 consecutive years. Yeah, we're all going to be learning a little bit more about this. But Tim, you keep bringing up, like, why aren't we seeing this with maybe some of the other ones?
Yeah, why are we only talking about this with regard to Meta Platforms?
They may be one of the ones that has the largest deferred tax asset, and that has really to do with timing and expensing of things like R&D, as an example.
So, you know, we're talking about a lot of things, and Ivan, we want to get, you know, your view on some of the other companies that have reported. Anurag, we do want to ask you though, what are you thinking that you're going to be looking for on the call going back to Microsoft, if you will, as we continue to see that one trading lower here in the aftermarket. Let me just pull it up on my Bloomberg because we have seen some pressure here. The stock continuing, it's down still about 3.4%. What do you want to hear from this company?
I think the number one thing would be.
Oh, let me get Anurag first. Forgive me, Ivan.
Okay. Sorry.
So the biggest thing for us is going to be, you know, what's the back half of CapEx spending? The CapEx in the first quarter was very high, 35 billion compared to 30, which they guided to. We want to know what is it going to be in the back half of the year. Are they going to slow down dramatically, or is it going to keep pace at where we are right now?
All right. Anurag, we know you've got research to write. We're going to let you go and look forward to reading that. Ivan, we want to stay with you for a little bit. We are talking with Ivan Feinseth, Research Director and Chief Investment Officer with Tigris Financial Partners. Anurag Rana, of course, our Senior Tech Analyst here at Bloomberg Intelligence. Ivan, other companies that reported, Meta obviously caught our attention. We just talked with Microsoft, or talked about Microsoft with Anurag. What's your take on what we got from them? Because that stock's down about 3% here in the aftermarket.
Well, right now we're in an environment of, you know, people have been buying these stocks ahead of results. They sell into the results, but I still say that this AI investment theme is powerful, and the companies leading it are Meta, Google, and Microsoft, and you got to buy on any weakness. I want to hear from Microsoft about increased AI-driven application engagement and subscription increases, how users are buying and implementing and using Copilot. Of course, you want to see growth in all key categories like cloud, Azure.
I mean, Azure was up 39%. That's pretty good, right?
Phenomenal. And that's their big growth engine. And they have been announcing huge contracts. So has Google. Unfortunately, Amazon had that outage, which was disappointing, but didn't really set back the stock. But these are the growth drivers, the cloud-hosted AI platforms.
Yeah, I was surprised to see Amazon stock actually higher that day.
I know.
But I think it also speaks to the power of Amazon, and like you got a good understanding of how much it has. Remember, the company is investigating outages. Microsoft is investigating outages of Office and game applications today also. So this kind of goes both ways. Ivan, on Microsoft, one more, and then we're going to get back to some more Meta platforms, I think. But a small 1.2% beat on adjusted diluted EPS on Microsoft. Everybody, the company does not give guidance in the statement. It does that on the conference call, or it's doing that on the conference call. Is it like worth even talking about it without even having it? Oftentimes we wait for the call to get more information, but in this case, like forward guidance coming from the call, it's kind of a moot point.
Well, the disconnect and the dichotomy that exists between companies and Wall Street is that companies plan for 1, 3, and 5 years, and Wall Street wants to measure everything on a quarterly basis. I mean, the guidance, it's somewhat important, but you wanted to see consistent growth driven by their investments in technology, the adoption and use of their technology that creates their competitive advantage. And those are the key things to look at. And we are in the first inning of the World Series of AI-driven global economic growth. And this trend is going to continue, and it's going to be powerful, and it's going to be game-changing. And I think that AI is going to enhance and create many more jobs than it will eliminate.
Going back to the cost thing, though, for Meta, I'm just that operating margin, 40% for the third quarter, down from 43% last year. Is that worrisome, or you think manageable?
Not really.
Okay.
I mean, we've looked at companies that have had huge growth trajectories while their margins were contracting. In fact, Amazon doesn't focus on margin. They focus on revenue growth. They don't focus on return on capital, actually, which is one of the key things we focus on, but they do drive a huge return. So, there are times where your gross margin can contract, but your economic margin can increase. And that is the economic margin is the difference between return on capital and cost of capital. That is the most powerful driver of shareholder value creation. So it's not so much important about what happens with gross margin. In fact, I've seen many companies drive huge growth by lowering their growth margin because you're just becoming more competitive and they're actually making it up on return on capital.
Okay, we're going to talk about Alphabet with you in just a minute. Carol reminded me that shares are surging higher in the after hours.
6%.
6%. Okay, one more on Meta platforms, down 8.4% in the after hours. Reality Labs losses for the third quarter, $4.4 billion. It's about the same as 1 year prior. Obviously, it's a huge investment area for Meta platforms. In the press release, Mark Zuckerberg specifically calling out the success of the eyewear and saying, essentially, I don't have it in front of me, but he essentially said, if we think the future is going to be what it is, this is going to be the most exciting moment for Meta platforms ahead of us. These will be the most exciting years for Meta platforms. What is the opportunity that Meta platforms has when it comes to eyewear?
This is going to be a tremendous communication and interactive platform, and it's only going to get better. In a few years, we're going to look back on these original glasses, the ones that they've launched from Ray-Ban, the recent ones from Oakley, and the functionality in a few years from now is just going to be more and more incredible. But this ability to engage with real-time information, to share pictures and images and videos in real time with other people that you're talking to. And while Mark Zuckerberg believes that the glasses are going to replace your smartphone, you're just going to keep your smartphone in your pocket and you're going to interact with data and information and people who you're communicating with these glasses. And eventually we're going to see ones that Meta just launched, ones with displays. It's going to be all about having displays embedded in the lens, so you don't even have to touch your phone. So this is going to be a huge growth opportunity. This is going to be what the cell phone was in the mid-90s.
No rose-colored glasses though right now, because Meta shares now down near their lows in the aftermarket, down about 9%.
I'm going to remember that. Ivan said this is going to be what cell phones were in the 90s. And by the way, he's not wearing any Meta glasses right now.
Well, and I will say our Mark Gurman really, really likes them as well. Hey, we do have to ask you about Alphabet, because we are seeing this one actually up about 6% here in the aftermarket. What do you like? What's of note, do you think, in their release?
Cloud growth, big cloud contract wins that they've had over the past few months with Meta, with OpenAI, with other companies. That Meta, Amazon, and Alphabet, Amazon, and Microsoft are building the AI and cloud infrastructure that everybody is connecting to and going to continue. And increasingly coming are going to be connected cars as we move through to full autonomy. So we are going to need high-speed, real-time, constant connectivity to the cloud. And those are huge opportunities for the three major public cloud service providers, Alphabet, Google, and Microsoft.
Well, and they're spending big. They're now seeing fiscal year CapEx 91 to 93 billion. They had seen about $85 billion. So, hey,
you got to spend money to make money, Carol. You got to spend money to make money. That's what they say.
It's wild, right? Like the number. They also, Gemini, their app now has over 650 monthly active users.
650 million?
650 million.
Okay.
Yeah. Didn't I say that? It's a lot. How do we know that this AI thing? How do we know that all this spend is going to pay off, Ivan? Are we still a little exuberant?
Well, because the functionality we see today is going to be blown away by the functionality in the future. More and more people are going to rely on this technology for all different aspects. And I do give credit to Tom Siebel, the founder of Siebel Systems and C3 AI, that I believe he said it, that every company is going to be an AI company. Every company is going to use AI on all aspects of their business, whether it's to manage supply chain, manage pricing, target marketing, that the functionality is going to increase and people are going to use, just like you said, Carol, when you wanted to understand more about Meta's tax charge, you Googled it.
Yeah.
And we're going to get more information. I did also. I like Perplexity. I looked it up in Perplexity. I did understand what they said, but it gave me a little more detail. And
you know it's right, Ivan? You know it's right?
Yeah.
Is it right?
Do I know
what Perplexity gave you back is right?
Yes. Well, because I do understand that the tax that it's really the timing and and of managing your tax payment and your tax liability that you tend to offset through capital investment, through R&D and other types of things that happen. So it's really timing issues on how your accrued tax liability or your accrued tax asset falls versus the taxes you will eventually have due or the tax credit you will eventually earn.
I just want to know, is this Sora? Is this really Ivan Feinseth? I just want to make sure.
It is really me.
Listen, perfect guest to talk about all of this. So much coming at us. Ivan, thank you so much. Really appreciate it. Ivan Feinseth, Research Director, Chief Investment Officer over at Tigris Financial Partners, over $500 million in assets under management as of the middle of this year, joining us right here in New York City.
It's not just the big tech companies that are reporting after hours. There is lots going on. Charlie Pellet has his eye on everything. Here's an update of Business Flash. Hey, Charlie.
And that's what we do here at Bloomberg. I thank you very much, Tim. This Bloomberg Business Flash brought to you by Oracle. Attention, growing businesses. Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. Earnings fast and furious. Alphabet reporting quarterly sales that beat analyst estimates after hours. Alphabet shares, they're up now by 9%. 13%. Microsoft reporting expansion in its Asia cloud computing unit that failed to impress investors. After hours, right now we got Microsoft down 2.3%. Meta, after earnings, tumbling now by 7.8%. Meta reported a $16 billion tax charge on its $16 billion charge on the tax bill, but not a problem for Ivan Feinseth at Tigris Financial Partners, who was interviewed moments ago right here on Bloomberg Business Week Daily.
We have seen investors make a mistake consistently in selling Meta platforms on capital investment increases. They continue to invest in driving their AI capabilities, which drives increased user engagement. It drives increased return on ad spend investment. So I like when they continue to invest, and we've seen this multiple times.
Ivan Feinseth of Tigris with the equivalent of a buy recommendation and a $935 price target. Starbucks also out with earnings. It posted positive same-store sales growth for the first time in over a year. The S&P 500 paused that rally today as Fed Chair Jay Powell minimized a December rate cut. S&P down 0.5 point, little changed at 6890. The Dow was down 0.2%. NASDAQ, though, pushing higher again, up another 0.5%. The 10-year on this Fed Wednesday, 4.07%, with a 2-year 3.59%. Gold down 0.2, $39.44 the ounce, and West Texas Intermediate crude 60.39 a barrel, up 0.4%. Bitcoin down 1.4%, 111,222 on Bitcoin. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. Do appreciate it. Okay, once again, got to bring in what's going on with these companies. Microsoft sliding after reporting that modest EPS beat. We're waiting for Microsoft's call to get forward guidance, so that's important to keep in mind. A small 1.2% beat on adjusted diluted EPS. Alphabet soaring as AI cloud demand supercharges earnings. And then Meta Platforms, looking at our live blog on Meta earnings, again, waiting for the call to start. Shares of Meta Platforms still down about 7.5%. We're going to talk to Kurt Wagner in just a few minutes and really get the details on this one-time charge of close to $16 billion, because still got to get to the bottom of that.
Well, and I can't ignore, and you pointed this out, this, expecting total expenses to significantly increase in 2026, continuing to invest at historic levels in AI. So the spend is on. Let's see what Brooke May has to say. She's managing partner at the independent wealth management and advisory firm Evans May Wealth. They have $1.5 billion in assets under management. She is with us from Carmel, Indiana. Brooke, nice to have you here. A lot of earnings. What jumps out, especially among we've got 3 of the Mag 7 out with the reports. Let me try that again. What jumps out at you?
Yeah, it's mixed. And, really right now what the street wants to see is that firms are able to spend on AI and monetize it. So those who can are going to be rewarded. When we look at the Mag 7 earnings expectation, earnings are expected to be up about 15% this quarter. And as we saw, Tesla had disappointing earnings last week. And so we really want to see decent earnings growth from the other 6 names. We've got 3 reporting today. We've got Apple and Amazon reporting tomorrow. And not only is it earnings growth, but it's what are they spending to improve the business? How are they investing in AI? And then how are they going to monetize it?
So are these decent earnings in your view from Meta, Microsoft, and Alphabet? Because the only one that's really moving up in the aftermarket is Alphabet. So as you said, we want to see decent earnings. So we got 3 of the big Mag 7 that reported. Are they decent earnings? Because right now, got Meta dropping in the aftermarket, and you also have Microsoft under pressure here in the aftermarket.
Yeah, Alphabet is the horse that I would put my money on right now. They've blown their earnings out of the water. Not only did they have good earnings growth, but the cloud growth was very strong. Search is strong. The street wants to see that Gemini can compete with not just ChatGPT, but other social media search engines. And, we're seeing that. In addition to, they want to see that AI-driven ad performance is improving. Plus, YouTube, what does the ad revenue look like there? So there's a lot going on with each of these companies. But right now, Alphabet is the one who's really knocked the ball off, or knocked the cover off the ball.
But is that just quarterly, or how, we just spoke to Ivan Feinseth, and Anurag Rana, and I think it was Anurag who made the comment about these companies are planning for the next 3 to 5 years, and Wall Street is looking at the next 1 to 2 quarters.
Exactly. I think Angelo Zeno also said
Angelo
with
who said
Microsoft,
that?
he said it's not really so important this quarter. He said, expect to double their revenue, over, I forget the time frame, but that's the longer term for Microsoft in particular.
So, Brooke, is your comment just about this quarter, or is it about the long run with Alphabet being the horse to pick?
I think it varies quarter by quarter. When we look last quarter, the Mag 7, they were expected to grow their earnings similar to this quarter, around 14%. And earnings growth is actually over 26%. So it's going to vary quarter by quarter. These companies, are evolving, and the platform, the AI space is evolving very quickly. And some are figuring it out. Some have been late to invest in AI and now are playing catch up. Alphabet, though, is one that we feel like really is a front runner in addition to NVIDIA right now. If I had to pick 2 of the 7, that's where I would put my money.
Let's talk Meta. Just real quickly, and we want to bring in Kurt Wagner, Bloomberg News senior technology reporter.
He's working. Can't you see? I see him. He's working right now, Carol.
We are too. We're trying to
I'd have a heads up. You were coming to me. I'm over here sending emails.
Listen,
what's going on?
Hey, making the sausage in front of everybody, because this is what it is. When we get a big drop of earnings, you can do it no matter what. Meta.
So.
Can you explain this?
Meta. I'll do my best. I mean, the numbers weren't bad from a revenue standpoint. They beat Q3 revenue. The guidance for Q4 was right in line with what what people were expecting for the holiday quarter, which is always the most important. I think the key here is that they said that their spending in 2026 is going to be way more. They were already spending, between 70 and 72 billion this year in capital expenditures. The spending, I think, was up, more than 30%. Now, next year, they said it's going to be meaningfully larger. So if you were sitting here, trying to get comfortable with this idea that Meta is throwing tens of billions per year, hundreds of billions over the next decade on AI, you probably were hoping that the Q4 numbers were going to be a home run, right? Not just an inline sort of, we'll do what we said we were going to do. You want that to be a lot larger if you're going to hear that the spending is going to ramp up as dramatically as it will in 2026.
So Kurt, you think the increased projection for expenses is what's moving the stock lower rather than this one-time tax charge, which, yes, we're going to ask you about?
That'd be my take, because the one-time tax charge
is one time.
One time,
and it's for a quarter that's now over and done with. And Meta, if you take them at their word, says that this big beautiful bill, which is what they attributed this one-time tax charge to, is actually going to be the bill is going to help them tax-wise long term. So I think if you believe that to be the case, there was a one-time accounting thing in Q3, and to me, the bigger flag is that they are, again, going to meaningfully increase spend here.
That's really helpful. Look, you wrote the book on Twitter before it was called X. You cover social media platforms. You are not a tax attorney, but I'm still going to ask you this question.
Sure.
Why is Meta Platforms the only one that's reporting this one-time expense, at least thus far?
Should I go back to my phone, pretend to be emailing so I don't have to answer this question?
Don't have to answer
I don't know. I don't know. I'm told that this is something that actually other companies are dealing with. I was told IBM and Broadcom, similarly, who have already reported, had similar tax things. I presume maybe other companies will as well. So I don't think they're the only one. Perhaps it's sort of getting a little bit more of attention than others. It's also possible that Meta is choosing, I believe they chose to do this giant one-time tax thing. It's possible others, maybe the implication being that maybe they could spread this out. You're right. I'm not a tax expert, so I'm sort of offering a little bit of guesswork here.
It's helpful, though.
But I don't think they're the only ones, number one. And number two, it's possible other companies are handling it in a slightly different way. That's what I will leave you with. I can't say for certain, don't ask any follow-ups. That's where I'm going to stop.
All right. Maybe they thought it was going to be a distraction from that. They're spending more money. I don't know, but it's really got me scratching my head. Kurt, do not go anywhere. We're going to come back to you in just a moment.
You can send some emails, but we're coming back to you.
You can.
Okay, thanks.
We're going to come back in just a second. Hey, we want to go back to Brooke May, managing partner at the independent wealth management advisory firm Evans May Wealth. So, Brooke, is there an investment play off of what we got from Meta, Microsoft, and Alphabet today for you? You mentioned, I think, that Alphabet was the name you like. Are you selling Meta? Are you selling Microsoft on this?
Microsoft is one I think we're going to have to reassess. When we look at Microsoft, they're not cheap. They're trading at 34 times forward earnings. And when you compare that to their growth rate, it's almost a 3, where, their PE is about 3 times their growth rate. And to us, that's expensive. We do want to continue to see momentum in their cloud business, and we expect that revenue to continue to be double digits. But, Azure, for example, is having a hard time keeping up with demand. The stock was only up 4% since the last earnings announcement, and it sounds like, they might have wiped all of that out today. And so, we need a catalyst, and I don't necessarily see the catalyst in the near term for Microsoft to move meaningfully higher.
And I should point out that shares of Microsoft have come off their lows in the aftermarket, still down, but just down about 1.3%. So not as negative as we saw earlier. Hey, Brooke, thanks so much for breaking all this down with us. Brooke May, managing partner at Evans May Wealth, joining us from Indiana.
I want to bring back in Kurt Wagner. He's Bloomberg News senior technology reporter. He joins us from Denver. And Kurt, I want to talk about the smart glasses, the Ray-Ban Metas, or whatever superintelligence is working on. This is what Mark Zuckerberg called out in the press release before this one-time charge. He said, if we deliver even a fraction of the opportunity ahead, the next few years will be the most exciting period in our history. The preceding sentence was, Meta Superintelligence Labs is off to a great start, and we continue to lead the industry in AI glasses. Is this the next computing platform?
I'm going to go ahead and say yes, because it's the only one that I think seems to be being built at the moment that I can think of, like that is in the way that you think of a phone, right, or a tablet or a personal device. And so it makes sense to me that the phone would evolve into something else at some point. I do understand why they think glasses could be that thing. It's something people already wear. It's hands-free, which I think is a huge perk. I think the challenge is going to be, as with everything, one, can you make the technology so small and subtle that wearing these glasses on your face doesn't feel weird or look weird? Because people aren't going to want to do it if they don't feel natural wearing the technology out in public. And then, I think, too, Meta's going to have a lot of competition. We've already seen Apple, coming up with their own device, Google coming up with their own device. I'm sure there will be others. So, on the one hand, if everyone is building towards this, it makes me think that it's even more likely that this becomes the thing after the phone. On the other hand, it's going to be harder and harder for Meta to maintain that lead that I do think they have right now. They're kind of the first one, they're the first ones with like a mainstream kind of hit in terms of the Meta Ray-Bans. But, that has a lot of technological sort of steps still to go before it, I think, reaches that level that we were just talking about.
So what's your number one question that you would ask Mark Zuckerberg today, or he and his team?
Well, I would want to know if he's got more investments coming in the AI space. And I don't mean just like investing in chips or investing in data centers, but like we've seen some of these other tech companies become equity shareholders or equity stakeholders in other AI startups. And because Meta can't necessarily acquire a lot right now, you may recall they're dealing with a lot of antitrust stuff in DC. We spent several weeks at their trial earlier this year. It feels like acquiring AI for them is going to be hard, but the idea of a mega investment seems more reasonable. So, as we're talking about AI and spending, I'd be curious to know, is all of this going towards infrastructure, or are you...
Kurt, thank you. Right now, Meta shares down about 7.2%.
Kurt, we're coming to visit you next week.
Next time, we'll give you a warning. But look at how well you did, even without that warning.
No, we really are. We're going to Denver next week. We're going to see Kurt there.
I hope so.
We will.
Kurt Wagner, senior tech reporter covering social media at Bloomberg News.
This is Bloomberg Business Week Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, folks. A big drop of big tech earnings. I'm just looking at NASDAQ 100 E-mini futures, and they're up about 0.4% here in the aftermarket. But that's
you think Nvidia's going to hit $6 trillion tomorrow?
It's like, what is? I don't even know Nvidia. Like, yeah, is it doing anything?
Well, when you spend, when you come out with capex that's raised, where are you going to spend the money?
Nvidia, I suppose, but lots of companies. Let me just look at Nvidia in the aftermarket to see it's up another 0.5% here in the aftermarket.
I'm Tim Stenovec, along with Carol Massar. Let's take a look at some stocks on the move today. We're joined by Bloomberg News cross-asset reporter Emily Graffeo. Emily, a lot moving in the after hours.
We have a lot of the big tech stocks reporting earnings. So let's start with Microsoft, ticker MSFT. This stock was down as much as 4% in after hours. Now it's only down about 2.5% in, just the first hour of the post-market. The earnings, EPS and sales were above estimates. And then the cloud service revenue did beat the average analyst estimate. So revenue for the first quarter, $77.6 billion versus estimates of about 75. The EPS also came in above. I mean, overall here, the stock is down, but when you consider the headlines that we're getting out of some other tech companies for this earnings, I would say so far so good for Microsoft.
First quarter, as you said, cloud. First quarter, Azure and other cloud revenue, X currency, up 39%. The estimate was 37.1%. Our own Anurag Rana saying that's a good number.
He did, yeah. He's out with a note, and he's going to be listening on this call, but out with a note right now. It says Microsoft's fiscal first quarter capital spending, including leases, came in at $34.9 billion, much higher than consensus $30.1 billion. And though this metric may raise concern for some, we see it as a signal of rising AI workload demand. That number's good news to Anurag and the team.
And I guess as long as the demand is there, right? Like the spend makes sense. Where do you want to go next?
Okay, Google.
Okay.
So ticker GOOGL. We're talking about Alphabet here, the parent company of Google. Rising, it was up 5%. It is now up.
I know it's moving around a lot.
It's moving around a lot.
It's still up about 4.8%.
Yeah. In the post-market, reported quarterly sales that beat analyst estimates. We were talking about Microsoft's cloud unit, but the cloud unit over at Alphabet also doing well, which is growing as AI startups seek Google's support and computing power. So the revenue for the third quarter beat estimates, coming in at $102.35 billion. The third quarter EPS also beat estimates, $2.87 a share. And they boosted their full year CapEx projection. So they see full year spending on capital expenditures, $91 billion to $93 billion. They had seen $85 billion. This is all on that continued spending on AI data centers that they need to do and custom chips. This is the big story, I would say, of tech stocks in 2025 of like, how much are you spending on AI? When is it going to pay off? What exactly are you buying? What are the projects? So listening for more of those.
Well, sometimes investors are cool with spending money on this stuff. Sometimes they don't react necessarily the way you want them to if you're long a stock.
Yeah, so sometimes they don't. I think we're all thinking of Meta here, ticker META. That stock is down over 7% after reporting earnings. And this is coming after Meta said it expects total expenses to significantly increase in 2026 as the company has to spend on data centers and other equipment to fuel the efforts in AI. You have to wonder if there were some specifics about the spending plan that maybe investors are picking up on, that it was different, that they didn't like that versus Google's. But yeah, I mean, it's a bit confusing here to see the stock down on this news, and then Alphabet obviously doing well on their promises to spend more on AI.
Yeah, it's kind of fascinating, right? Like the stories being told by each. I mean, keep in mind, Meta is up almost 30% here in 2025. Alphabet is up about 45% here in 2025. And like, what's Microsoft? Microsoft is up almost 30% this year. I mean, whoa, these guys have been on fire, and we know that.
And we are getting more headlines out of Meta that the company reported third quarter net income of $2.71 billion, which included a non-cash income tax charge of $15.9 billion due to the implementation of the tax bill that was signed into law in July. So again, this is something that I don't think investors were expecting out of the earnings, so could be weighing on the stock as well, that they're reading headlines about a tax charge and these headlines about expenses increasing. So at least for the post-market, that stock is down after those earnings.
I will say, too, we're getting some calls on the live blog. Meta assuring analysts on the call that it still expects significant cash tax savings for the remainder of the year, despite the hefty tax charge. They are talking about Zuckerberg signaling that Meta may have some news coming on its AI models and products, saying that his team has been heads down working on the next generation and that he's looking forward to sharing more on that over the coming months. For those who are on radio right now, Tim is playing around with his glasses.
Because that's what Mark Zuckerberg thinks the future is. He may have renamed the company Meta Platforms, but he's really leaning into augmented reality and virtual reality.
Meta
with these
Ray-Bans.
Meta Ray-Bans, yeah. Called it out in the release.
Yeah.
You're not wearing them.
I'm not
You're
wearing them. But you know, it is fun if a friend is wearing them and then they take a photo of you. And it's like, oh.
Sebastian, one of our producers, does that at some of our events. It's pretty cool.
Yeah.
He likes those Meta Ray-Bans.
Mark Zuckerberg saying on the call that he's investing in computing capacity based on his most optimistic forecast for achieving super intelligence.
Yeah, I mean, this is like hundreds of billions of
Does
dollars
super
here.
intelligence come with a cape? I don't know.
A big thank you to Emily Graffeo, Bloomberg News cross-asset reporter. For more conversations like this, check out our new Stock Movers podcast. You can listen to Stock Movers wherever you get your podcasts.
What a day. Check out our podcast if you missed anything. Everything you need to know about those big tech earnings, but everything you need to know about politics coming your way. Balance of Power starts now.
This is Balance of Power, live from Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. I'm Joe Matthew. Tonight, the Fed makes cuts amid a slowing job market.
For some part of the committee, you know, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether, in fact, the growth, that the stronger growth that we're seeing is real.
The comments from Fed Chair Jay Powell this afternoon, looking to shore up a softening job market. What Powell said about today's cut, and more importantly, what he said about a potential December cut that caused the markets to dip today, when we're joined by Bloomberg's Michael McKee, who was in the room. Plus, fresh congressional reaction when we speak with Senate Finance Committee member Senator James Lankford just moments from now. Also, we're now just hours away from that highly anticipated Trump-Xi meeting. The two leaders expected to formalize a trade truce after months of chaos, potentially putting the world's biggest trade fight on hold, at least for now. We'll speak with Illinois Congressman and top Democrat on the China Select Committee, Raja Krishnamurthy, and Foreign Relations Committee member Senator Chris Coons on that and more. Also, NVIDIA breaking records, becoming the world's first $5 trillion company today. That news coming as we get earnings reports from the likes of Meta, Alphabet, and Microsoft just after the close. We'll dig into it all with Bloomberg Tech's Caroline Hyde up ahead. But we begin this evening with a high-stakes meeting expected to happen less than 5 hours from now. President Trump sitting down with China's Xi Jinping. The stakes could not be higher as the two leaders look to cool their heated trade rhetoric and pause the tariff war that's been going on now for months. From soybeans to fentanyl, everything seems to be on the table tonight. And Bloomberg's Tyler Kendall reports now the latest live from South Korea. Tyler, what do you have?
Yeah, hey, Joe, good evening. You laid it out there. The stakes could not be higher here on the ground in South Korea. Now, we are widely expecting that there will be an extension when it comes to the trade truce currently in place and set to expire on November 10th. And that's seemingly in exchange for a pullback in some of the recent escalations that have happened in the weeks leading up to this. That includes Bloomberg News confirming that China has begun to purchase U.S. soybeans, though the numbers as of now are relatively small compared to the nearly 12 $12.6 billion worth of imports they did last harvest season alone. Also, according to the Treasury Secretary, Beijing will delay its newly unveiled export curbs on critical and rare earth minerals. And the U.S. is taking some similar steps, too, taking off the table, it appears, some threatened but not yet imposed restrictions when it comes to things like critical software and cloud computing. Now, I mentioned there could be an extension to the trade truce. We could also see a reduction in the tariffs that are currently in place. President Trump suggesting as much himself, saying that he could lower the 20% tariff that is linked specifically to fentanyl, as both sides have said they made progress around the issue. And then, of course, President Trump raising the stakes even higher today, earlier telling reporters that he is going to bring up NVIDIA's Blackwell chips with the Chinese president later on. Now, of course, this is something that would be seen as a market plus when it comes to NVIDIA, which has been trying to regain market access to China since at least 2022. Now, Joe, there's a lot on the table. A lot hasn't been finalized yet, including what the administration would say about some potential critics when it comes to national security concerns over any potential sales of NVIDIA chips. But I have to say, covering President Trump here on the ground, it is clear that the White House is trying to gain as much leverage as possible going into this meeting. Joe, today the U.S. inked this trade deal with South Korea, of course, focused on those critical sectors when it comes to competing with Beijing.
Tyler, thank you so much. Bloomberg's Tyler Kendall reporting live from South Korea, and we'll have much more for us tomorrow on the meeting. To the other big story we're following now, the Fed decision to cut rates by a 1/4 percentage point, the central bank's second consecutive rate cut as the Fed moves to support a softening labor market. The Fed also said it would stop shrinking its portfolio of assets on December 1st. And Fed Chair Jay Powell said another rate cut in December is not guaranteed. Take a listen.
We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it.
And joining us now with details of today's Fed decision is a man who was in the room with the Fed chair, Bloomberg's Michael McKee. It's great to see you on a Fed day in Washington. As always, Mike, you told us on the early edition of Balance of Power that this is exactly what the Fed chair would say. And so what to do with December in a dearth of economic data?
I think it's more than the dearth of economic data, although that complicates their job quite a bit. I think it's that they really don't know where inflation is going because of the tariff situation. I mean, we could have, Tyler could be reporting a whole new change in tariffs by the time we wake up tomorrow morning. And we don't know what the employment situation is going to be. AI seems to be driving a lot of job cut announcements these days. Are we going to see the unemployment rate shoot up? They just don't know, and they probably aren't going to know or have a really good idea of what's going to happen by December. So what Powell seems to be telling us is there's enough opposition to a December rate cut. More people would like to have them sit still and wait and pause and see what effect their rate cuts are having and what is happening in the economy before they go again.
The administration has gone out of its way, Treasury Secretary, the president, everyone in between, that tariffs are not inflationary. Jay Powell said today very simply and directly, higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. So who's wrong?
The administration's wrong. Tariffs are a tax, and they are inflationary. They do push up prices. The question is, how long does that inflation last? The argument that the Fed is buying is that it will be a sort of one-off event. Now, it's not going to be one day, as it was when Smoot-Hawley went into effect. It's going to be each time the tariffs come on to a different sector, they will slowly raise prices as companies adjust. But then they stop. Still, it leaves you with higher prices overall, and that is an affordability problem, a political problem as well.
Fascinating as ever. Bloomberg's Michael McKee on this Fed Day in Washington. We thank you, Mike. And joining us now live from Capitol Hill is Democratic Senator Chris Coons of Delaware, who serves on both the Senate Foreign Relations Committee and Senate Appropriations Committee. We come back full circle to our top story, Senator, and that's the president's meeting tomorrow with Xi Jinping. It's great to have you back on Bloomberg TV and radio. I wonder if you are optimistic for what could come from a trade deal with the world's second largest economy, or if you're in fact worried that the president could somehow mortgage our national security with the idea of dealing around high-end AI chips made by NVIDIA.
Well, Joe, thank you for the chance to be on again. I am gravely concerned that President Trump fails to appreciate what a permanent advantage he would be giving away if he is to green light the sale of NVIDIA's advanced Blackwell chips. They're a dozen times more powerful than the H20 chips that he's already allowed NVIDIA to sell to the People's Republic of China. And this would allow the Chinese to gain an advantage over us in training new AI models, in threatening our safety, our industry, our military advantage. It would make their missiles more powerful. It would allow them to carry out more effective cyber attacks on our businesses and our national security infrastructure. It frankly would make China a far more lethal competitor to the United States. And in exchange for what? For a temporary advantage in the sale of soybeans or a temporary benefit in terms of rare earths or critical minerals. As you know, President Trump recently had a successful meeting with the Prime Minister of Australia. We have several close allies, Australia, Canada, Norway, that have abundant critical minerals and rare earths. We should be moving forward with closer partnerships with them, not selling the farm to China.
So what should be President Trump's posture tomorrow in this meeting, Senator? You just took off the list, you took off the table exactly what Xi Jinping is looking for. He'd love to have more than the H20 chip, apparently, and you've got Jensen Huang in President Trump's ear saying that the U.S.-made stack should be adopted around the world if we want to win this AI race. How do you rationalize these two?
Because the key difference here is that these Blackwell level chips allow the Chinese to train new models. With DeepSeek, they've already shown that they've got a significant competitive edge in the intellectual capability, in power, in energy, in the data set that they're able to access because of the size of their population. AI is absolutely critical to the competition of the 21st century: economic, political, social, and military. So I would not put that on the table. I would instead continue to talk about traditional commodity relationships, about reducing fentanyl exports, increasing soybean purchases, lowering tariffs in a way that can help both countries and both economies. But to give away these chips is to give away the keys to the kingdom and the one area where the United States still has a critical competitive advantage in the race to AI.
Well, this very idea was enough to send NVIDIA stock to an all-time high once again today, Senator. So we'll all be listening very closely to what happens here. And I'd love for your point of view still on the Foreign Relations Committee to give us your sense of what is happening in the Caribbean and the effort to have a War Powers Act passed in the United States Senate. The president has announced, the administration has announced any number of additional boats that have been destroyed now on the Pacific side, which is interesting. We had been seeing this off the coast of Venezuela. Now apparently it is including Colombia as well. The president has also acknowledged the fact that there was a covert CIA operation approved for on-the-ground operations inside Venezuela. What are we on the threshold of here, Senator, if nothing less than regime change or an actual war in Venezuela?
Well, Joe, that's a great question to which we in the Senate don't have a clear answer. It is an indicator of a steady march towards regime change. The size and scale of the flotilla that President Trump has directed to deploy to the southern Caribbean, the more than dozen strikes that have killed nearly 60 people in both the Eastern Pacific and Southern Caribbean. Look, I'm no fan of Maduro. He's a brutal dictator who's driven his country into poverty and pushed millions of Venezuelans to flee. But intentionally, through military action on the ground, overthrowing a head of state of another country has serious consequences. And the president owes the American people and Congress, given our critical Article 1 power, an explanation of what's the policy and what's the plan. What will happen on the day after? I don't need to cite more than Libya and Iraq to give you examples where action initiated by the United States and our allies overthrew a stable government, although a brutal authoritarian government, and we did not have a clear plan for the day after, and the consequences for both the people of Libya and Iraq and for regional stability have been tragic. We should not sleepwalk into war. In closing, I'll remind you, President Trump ran on lowering people's costs, making America healthy again, and no new foreign wars. Costs are going up because of the tax known as tariffs. Health insurance costs are going to skyrocket starting this weekend. And I'm afraid President Trump is leading us slowly into a war with Venezuela. None of these are what he promised, and all of them we should step back from or change direction from.
Senator Coons, it's day 29 of the government shutdown, and we have a couple of headlines coming from the Senate leader, Republican leader John Thune's office. Number one is that he's preparing to, or seems to be on the threshold of, talking with Democrats. There's also an effort to fund SNAP benefits, food stamps, with a couple of different versions of the legislation. There's a Republican and I believe 2 Democratic versions. Listen to what John Thune said about this earlier today.
They're going to propose a bill to fund food stamps during their shutdown. Mr. President, this request is a transparent admission that Democrats want to keep the shutdown for what? Another month? Longer? This bill is a cynical attempt to provide political cover for Democrats to allow them to carry on their government shutdown for the long term.
To be clear, Senator, there is a Republican version as well that's been put forth by Josh Hawley to fund SNAP benefits during the shutdown. Where do you fall on this idea of paying some people paychecks, federal workers, fulfilling some programs but not others, as opposed to actually reopening the government and getting everyone back on board? Would you vote for this?
Well, Joe, I think we should reopen the government, and we should have Republicans at the table willing to negotiate with Democrats. The House has been out of session 40 days. President Trump's on the other side of the world. Leader Thune is refusing to negotiate with us until after we reopen the government. And I think Republicans need to show that they are committed to changing course on the rising health care costs that millions of Americans are facing. That's what should happen before we reopen the government. It's not that hard. They just need to sit down and negotiate with us. But the posture that Leader Thune has taken throughout this entire period has been he will not negotiate with us until the government's reopened. There was an effort on the floor today by Senator Ben Ray Lujan of New Mexico to ask for consent that we would fund SNAP and WIC so that hungry Americans won't suffer in the coming week or weeks. I support that. I'm going to be attempting tomorrow to get unanimous consent to pay our troops, those who are active duty, Guard, Reserve, Coast Guard, civilians. I think what you're seeing here is steady movement towards trying to reopen the government in exchange for real constructive negotiations on avoiding the spike in healthcare costs that's facing all Americans by the end of this year, and particularly high spikes for those who are on the Affordable Care Act.
Well, Senator, we appreciate your view. Chris Coons of Delaware, thank you as always for joining us on Bloomberg TV and radio. Coming up, this shutdown and more on today's Fed decision when we spend some time with Republican Senator James Lankford of Oklahoma. And later this hour, we'll look ahead to tonight's historic summit between President Trump and China's Xi Jinping with Democratic Congressman Raja Krishnamurthy of Illinois, ranking member on the House China Select Committee. It's all ahead on Balance of Power on Bloomberg TV and radio.
to be lowering that because I believe that they're going to help us with the fentanyl situation. They're going to be doing what they can do. We have to have the meeting. Our meeting tomorrow. That's a big meeting. And fentanyl will be one of the things that we're discussing. Importantly, we'll be discussing the farmers. We'll be discussing a lot of things, but fentanyl will be one of the things we're discussing.
It's Balance of Power on Bloomberg TV and radio. I'm Joe Matthew. Thanks for joining us. That, of course, the president teeing up his meeting with China's Xi Jinping, speaking with reporters on Air Force One. That meeting now less than 5 hours away, with the president saying that he could lower tariffs the U.S. has imposed on Chinese goods over the fentanyl crisis. Big shift in the administration's trade position. That's news. Joining us now with his perspective, live from Capitol Hill on this and other matters, Republican Senator James Lankford of Oklahoma, member of the Senate Intelligence Committee and the Senate Finance Committee. Senator, it's great to see you. Welcome back to Bloomberg TV and radio.
Joe.
Should export controls be on the table for this conversation?
Yeah, we should put everything on the table to actually have real conversations about what we're going to actually bring in and out. We buy a lot of toys and a lot of different products from China, but we're also dependent on them for critical minerals. They're dependent on us for energy and a lot of other products that are coming that way. So let's talk about it.
Well, of course, Blackwell chips made by NVIDIA are not toys, Senator, and there are a lot of concerns about the advantage that could provide the Chinese in the AI race. Does it worry you that they could have their hands on that technology?
Yeah, it does worry me. Actually, they shouldn't, and we don't. We currently have limitations on that particular product based on the advantage that they could gain from it. We are far ahead on the AI frame, but we want to make sure that we stay that way. When you're a rival like we are with China, we want to be able to make sure that we keep our competitive advantage.
Well, I mean, you know, NVIDIA shareholders today were counting the dollars to see what it would actually be like to reopen the Chinese market, and the stock hit an all-time high on this expectation. It sounds like you're tapping the brakes on this idea, though. Do you think the president would make that offer?
Yeah, we'll see what the president makes the offer on. He's smart enough to be able to know just exactly what that would mean long term. If you're going to keep American competitive advantage, we need to be able to keep American competitive advantage in every area on that, but especially in technology and innovation. We understand full well what the Chinese are doing, both in their military capabilities, but also what they're working on with quantum, what they're working on AI, all of those different aspects as well. The NVIDIA chip is actually exceptionally valuable to the United States in maintaining that advantage. We'd like to be able to keep it that way and should.
Is it worth it, though, if we make Oklahoma's farmers and ranchers whole in a trade deal with China that would get the soybeans and the other agricultural products flowing again?
Yeah, there are a lot of other ways to be able to negotiate dealing with soybeans and trying to be able to open up to beef and to pork and so many different agricultural products that China has agreed to be able to purchase in the past and then broke their deal on that. So I don't want to be able to open up the chips. Once those chips actually get there, then they could just break the deal again and walk away, and they've already got access to the chips that they need for it. So we need to be very attentive and very, very careful in any kind of negotiation that deals with high technology like that.
I'd love to ask you, Senator, about the government shutdown as well. We were just talking to your colleague from Delaware, Chris Coons, about it. It's day 29 here, and there was an important headline, John Thune suggesting that he's going to meet with Democrats. He said that opportunity would arise soon. I don't know if he means Chuck Schumer or if we're talking about other members of the Democratic coalition in the Senate. But would that suggest the end is in sight, or are we going to set a new record next week?
I hope it is. We've already set a new record. This is the longest full government shutdown. Previous times, we've had what's called a partial government shutdown, where part was funded and part was not funded. This time, nothing has been funded, and we've actually attempted multiple times to try to get funding, even to part of the government, and Democrats have refused to do all of this. This reminds me a lot of 2013. In 2013, Republicans at that time were complaining about Obamacare. We shut down the government for 2 weeks. Democrats over and over again said we will not negotiate anything on health care while the government is shut down. Now, literally a decade later, we now have a situation where Democrats have shut down the government over Obamacare. They want to add more money to Obamacare. Republicans have said, no, we're not going to talk about this while the government is shut down. But it's been a month now, and now we're bumping into SNAP being cut off, federal workers missing yet another paycheck. We've got all kinds of repercussions that are happening around the country. And for whatever reason, my Democratic colleagues have not been able to decide what they want as the end to the shutdown. There's at least 3 or 4 different proposals that are sitting out there, and they've not been able to circle around and be able to bring John Thune, here's what we're looking for in it.
I know that you've become heavily invested in a couple of bills that helping to solve the shutdown here. One of them, in fact, would fund SNAP programs and air traffic controllers. Can you pass it if it gets to the floor?
Probably. Trying to be able to figure out the best way to do this. The problem is that still leaves out federal housing and all those folks on housing assistance. That still leaves out the members of our military. That leaves out all kinds of different folks, our Indian tribes. Anytime you start picking and choosing which one of your children you like the best, you run into all kinds of problems on that. This is literally Democrats saying, well, we want this constituency, but not that one. We're saying, listen, just open it. Enough is enough. We're saying literally the same thing that federal employee unions are saying to Democrats. We get your point. You don't like President Trump. Everybody hears you. You don't like President Trump, but why are you punishing all these different people that are not affected by all this? You don't like President Trump. Everybody understands that, but we don't need to be able to punish SNAP recipients nor federal workers and their families in this process. You mentioned those bills. I actually have a bill last year I brought that actually ends government shutdowns entirely. This particular shutdown, our GDP will lose at least $8 billion in GDP, at least, just from the loss that will happen during this time period. We need to end government shutdowns entirely. I had 57 votes for that last year. We hope as soon as this shutdown is over, we can bring that back up again and say, let's make our last shutdown we ever have, and to make sure that we keep flat funding when we get to a moment like this. We stay in session continuously until we solve our problems, but keep the pressure on Congress, not on federal workers and not on SNAP recipients.
Understood. Senator, thank you for being with us. Republican Senator James Lankford of Oklahoma on day 29 of our government shutdown. President Trump is truthing, remembering, of course, he's going to be sitting down with President Xi in just about 4.5 hours. This just hitting Truth Social following his visit to South Korea, which he says has agreed to pay the USA $350 billion for a lowering of the tariff, he says, charged against them by the U.S. Additionally, agreed to buy our oil and gas in vast quantities, and investments into our country by wealthy South Korean companies and businessmen, he says, will exceed $600 billion. On China, the president posting on Truth Social in anticipation of the meeting. Very much looking forward to my meeting with President Xi of China. It will take place in a few hours. President DJT. We are just hours away from the president's meeting, and we'll have much more ahead right here on Balance of Power on Bloomberg TV and radio. This is Balance of Power on Bloomberg TV and radio. I'm Joe Matthew. Thanks for joining us as we follow breaking news here after the bell. 3 of the Mag 7, Meta, Alphabet, Microsoft, all dropping earnings reports tonight, quarterly results after the close. Not all are made the same, as noted by investor reaction here. And joining us now with Power Moves, Bloomberg's Caroline Hyde, who joins us live from World Headquarters in New York. Caroline, it's great to see you. You want to start with the good news or the bad news?
Well, let's go good news, because Alphabet's the only standout here, and it was trading at a record high today, and it goes yet higher in after-hours trading, as you point out, Joe. And this is as we're rewarding the company that is showing growth in cloud. Remember, Google is the number 3 after the likes of Amazon and Microsoft, but they're managing to bake in more than 30% growth in terms of their overall cloud offering. They're really being seen as the key competitor, having recently won over Anthropic, that's also been relying on AWS, for example. But we're also notably seeing that the advertising part of the business is still going great guns. That's even as we concerned about maybe the search competition that's coming from the likes of OpenAI. That's not showing up in the numbers, so people still driving Alphabet shares higher. So I think that's a notable winner. And actually, we're rewarding capital expenditure that gets raised again. Fiscal second quarter, we saw them rise to $85 billion for their capex for the full year. Now they're going up to $92 billion, Joe. So a reward here for Alphabet, but not so much for the others.
Not so much for the others, indeed, and they're being punished for it. That's the environment that we're in. NVIDIA, on the other hand, continues to reach to the sky, Caroline. Jensen Huang is the $5 trillion man. Is this all about the speech yesterday?
It's about the speech, and it's about what's going to happen in just a few hours. You've been talking about relentlessly, Joe. It's really important to keep thinking about Xi and Trump. What will get discussed in terms of the future iteration of Blackwell? The architecture that might well have to be dumbed down to ship into China, but does that help him access that market? At the moment, he is managing to point to $500 billion worth of sales of both Blackwell and Rubin, the next iteration of his chips overall offering that we have in terms of servers as well, and the entire software tech stack. He's saying that he's got $500 billion of orders for those key offerings, with 0 going to China. If he can start selling into China, that just pushes him higher. It'll be interesting to see how NVIDIA reacts, though, to some of the numbers that we saw coming out of Microsoft and Meta. Now, Microsoft, of course, is being a bit punished today, but they, too, are refocusing on capital expenditure, rewarding really, NVIDIA really is the GPU king for them. They've been going not only to their own overall Azure growth, which they did beat in terms of expectations. They saw 39% growth in terms of their Azure cloud, but they're also having to rely on Nscale and Nebius and some neo clouds, because supply is the constraint, not demand. So with Microsoft still committing to capital expenditure, Meta too also saying 2026 is going to look even bigger for capital expenditure for them than 2025. Look, the shares of Meta are actually falling on the back of its numbers, even though we saw record revenue. We did see a tax implication on their earnings per share, but once again, maybe with Meta and Microsoft, we're not seeing the sort of rewards that Alphabet got. Remember, a lot of these companies have been trading at record highs, and a lot of them have significantly outperformed on the year. But it still seems to be a tale of two cities as to who we're going to push share prices higher of. But for now, NVIDIA just keeps catching that bid. 73 analysts say buy it, only 1 says sell.
Incredible. Incredible moment we're in. Caroline Hyde, what a treat to spend some time with the co-host of Bloomberg Tech. Thank you, Caroline, for setting us up here. You can catch Caroline, by the way, alongside Ed Ludlow every morning. I suggest you do. 11 a.m. Eastern, 8 a.m. Pacific here on Bloomberg TV. Back to our top story tonight, the impending meeting between Presidents Trump and Xi in South Korea. We're just hours away. The president posting on Truth Social just moments ago saying, quote, very much looking forward to my meeting with President Xi of China. It will take place in a few hours, unquote. Well, that's correct. The meeting soon coming after President signaled that he was open to providing China with access to what Caroline was just talking about, NVIDIA's Blackwell GPUs, as part of a trade deal, presumably would represent a major concession if this happened. Take a listen to what the president said to get all the talk going here, discussing the chip earlier today on Air Force One.
We'll be speaking about Blackwell's the super duper chip. Blackwell's amazing. NVIDIA makes it. And Jensen is an amazing, brilliant man. I think we may be talking about that with President Xi.
Joining us now with his reaction to this and more, Democratic Congressman Raja Krishnamoorthi of Illinois. He's ranking member on the House China Select Committee, which is why we have talked about this very idea before in terms of export controls, just not for Blackwell. Congressman, it's great to see you. Welcome back to Bloomberg TV and radio. Is this about to happen?
I hope not. I hope that they think better of this particular issue because, look, we can't export our highest-end semiconductor chips to China. It doesn't make any sense. They will be used to help modernize the Chinese military and be used to perfect their AI models and their surveillance and other systems that are used to persecute Uyghurs, Tibetans, Hong Kongers, and dissidents. This not only is bad for our national security, it runs counter to our values. And so I hope that they do not relax the export controls on the Blackwell chips or any other super duper chips that we might have.
Well, to be honest, I thought being tough on China was the last bipartisan activity left here in Washington, D.C. Congressman, we just had two senators, a Democrat in Chris Coons, a Republican in James Lankford, say basically what you just said as well, questioning this idea, suggesting that the president should reconsider. So why is this happening?
I don't know. I think that the president should listen to his advisors. He should not shoot from the hip on this particular issue. Look, I think that when he does this, he reveals weakness and lowers our deterrence with regard to economic, military, and technological aggression by the Chinese Communist Party. And when that happens, you basically invite aggression and potentially conflict. We don't want that. The American people do not want a conflict. They don't want a war. They don't want anything like that with China. And so let us instead go a different route. We have leverage. I hope the president uses that leverage to his advantage. The biggest source of leverage that he has is access to the American market. The Chinese desperately want access to the American market. We want to bring stability and predictability in that relationship. We want the Chinese Communist Party to lower their shipments of fentanyl precursors that fuel our fentanyl epidemic. We want them to, of course, continue to buy soybeans from Illinois and American farmers. And we want them to stop the dumping, which they continually do, to basically destroy their competitors here in America and among our friends, partners, and allies elsewhere.
You know, Jensen Huang had the Capitol wrapped yesterday with his keynote address at NVIDIA GTC, and he has made the point, I'm sure he's told you this personally, Congressman, that the world needs to be on the U.S. stack if we're going to win the AI race, suggesting that otherwise the world could be on a Huawei stack and China could find itself in an advantaged position. We've got competing philosophies here. Is there some truth to what Huang is saying, and is the president about to make that happen?
Well, look, this is what I told Jensen in my office when he told me the exact same thing. Yeah. Guess what, Jensen? They are already trying to make a Huawei stack that will replace your stack. And they're going to continue to do so relentlessly. And then they're going to cut you out as well as soon as they learn everything they can from your technology. So let's be very clear-eyed about this situation. Among our friends, partners, and allies, we need to make sure that we don't either export our highest-end semiconductor chips to be used by the CCP, or any equipment that could be used to fabricate those chips, or any other technology or know-how that could be used against us. That's just the nature of this particular situation. We got to maintain our lead. Whatever we can do to expand our partnerships among trusted partners, let's do that. But let's not give away the store to the CCP. They will use it against us, just as they have with every other technology out there.
Just lastly on this, and I'll change the subject to the government shutdown here in a moment, Congressman. That's news. What was his reaction when you told Jensen Huang that the Chinese were going to cut him out? And did he tell you that he was hoping to sell Blackwells in Beijing?
No, not necessarily. I don't want to get into all the details of our conversation, except that he and I obviously disagree on this topic. But I have to look out, as my colleagues, Republicans and Democrats alike, for the best interests, the best national security interests of our country. And all I could say to President Trump is this, which is, look, this is one area where we maintain a lead, that we will continue to maintain a lead on, but it only will exist if we don't kind of do damage to our standing by exporting these chips to the CCP. And by the way, we have to continue to fix other parts of our ecosystem. So for instance, upskilling our American workers to work at places like NVIDIA, as well as fixing our legal immigration system so that the best and the brightest can continue to man the fabs. And we invest in our research and development here in the United States, which unfortunately is being hollowed out as we speak by the Trump administration. And so I'm concerned about those issues, but we can maintain the lead. We can win this competition if we be the best version of ourselves.
Congressman, the House has been out of session, I believe, for over a month at this point. It might even be more than 40 days. I'm starting to lose count, although it is day 29 of the government shutdown. And we've been exploring ideas here this hour on how this might end, although we're coming up pretty short here based on the conversations that are being had in Washington. Listen to what the Speaker of the House had to say a bit earlier. This is Mike Johnson.
We're all concerned about the timing. The Democrats are eating up the clock. We have very important work to do here, and that's why we're pleading with them, not Chuck Schumer. Look, I think Chuck Schumer and Hakeem Jeffries are irredeemable at this point. I don't think they'll be able to tell Mondami in New York and his disciples that they voted to open the government. I've given up on the leadership. So we're trying to appeal to a handful of moderates or centrists who care more about the American people and will put the people's interest over their own and do the right thing in the Senate. I mean, there's no point in me sitting down with Chuck Schumer. He's painted himself into a corner.
So he just said a lot there, Congressman. Here on day 29, you hear the references. This is the Schumer shutdown. This is what Republicans say. And, of course, Democrats, as you will probably tell me, say that they haven't had a chance to sit down and negotiate with Republicans. But we are coming up. The timing is difficult on this date of November 1st when SNAP benefits begin to expire and when open enrollment begins. Will that be the date that brings this shutdown to a close? Or are you and I going to be talking about this over turkey on Thanksgiving?
I hope not. And Mike Johnson, God bless him. He can just call us back into session today. But I think the reason he doesn't is because two things. One, I think the president doesn't want him to call us back into session because shutting down the government also shuts down the Epstein file inquiry. As you know, if we get called into session, Adelita Grijalva from Arizona gets sworn in, and she's the 218th vote to force the legislation to come to the floor to make the president disclose the Epstein files. That's point number one. Point number two is this, which is that, look, the president and his party controls all branches of government at this point. That's why public sentiment is really turned against the Republicans on the shutdown. They want the president to come to the table. Don't spend time building a golden ballroom. Come to the table, and we can solve the shutdown in 10 minutes flat. I guarantee you that Leader Jeffries and Leader Schumer will be ready to go, and we can solve this, extend the Obamacare tax credits, avoid these exploding health care premiums. We can solve this in probably 5 to 10 minutes, I think.
You know what Republicans say, though, Congressman, is that you need to reopen the government to negotiate, and that they have voted 13 times to reopen the government. Democrats have voted no.
They've voted 50 times to repeal Obamacare. They've voted numerous times to defund Obamacare. We know exactly where they stand on the Affordable Care Act. You can't trust them with the Affordable Care Act. And so let us take that issue off the table right now. We have 22 million people who are about to receive notices because they can't otherwise afford Obamacare without those tax credits. 4 million Americans are about to lose the ACA coverage because those healthcare premiums will be beyond their reach. And so let's just take it off the table right now.
Democratic Congressman Raja Krishnamurthy of Illinois. It's good to see you, Congressman. Thank you for joining, as always. Coming up, we'll continue the conversation on the impending summit between President Xi, President Trump, with our political panel, and how Democrats are using the president's ballroom construction as a shutdown talking point. It's next on Balance of Power on Bloomberg TV and radio. It's Balance of Power on Bloomberg TV and radio. I'm Joe Matthew. Thanks for joining us. We'll turn back to the impending meeting between Presidents Trump and Xi in a moment. First, today's Power Brief. Voters in the Netherlands are casting their ballots in a snap election focused on issues like affordable housing and reining in immigration. Might sound familiar, with progressive Democrats and the far right set for a tie. Mainstream parties ruling out a potential coalition due to an anti-Islam lawmaker, Geert Wilders, backing out of a four-way ruling coalition over a dispute over immigration, an issue that continues to polarize Dutch voters. More clarity on the outcome of the race is expected throughout the night and into tomorrow morning. And tonight, while Democrats and Republicans stick to their shutdown talking points 29 days in, the president's ballroom construction is coming under attack. Again, with Democrats now increasing their probes of the construction and the fundraising effort behind it. Here's Senate Minority Leader Chuck Schumer earlier today.
So what's Trump doing? He's busy building his ballroom, dancing in Malaysia, sending $40 billion to Argentina, $300 million for his ballroom, $170 million in luxury jets for Kristi Noem. They have money for that and not for health care?
Joining us now with their reaction to this story and more, this evening's political panel. Roger Fisk, former aide to President Obama, our Democratic strategist, alongside Republican strategist Annalise Keller, partner at 7 Letter. Wonderful to see you both, and welcome. Does Chuck Schumer have a point?
I don't think so. It's on Chuck Schumer.
Yeah.
He's got to get those votes in the Senate. This is where the logjam has been. They've got, I mean, you're totally right. Republicans and Democrats have stuck to their talking points.
Sure.
The one that's most interesting to me is this talking point that Republicans can go it alone. They control Congress. They control the presidency. Thus, they can reopen the government. I think we all know that's not true and that it takes 60 votes in the Senate unless you want to get rid of the filibuster, which I mean, Republicans don't. I don't. That's a terrible idea. So we've got to get Democrats to figure out what their off-ramp is here. What are they going to take as a win? How are we going to get this reopened? Because this is this is the longest shutdown in history of the entire government.
That's right.
And next week, people are really going to feel it with the expiration of SNAP benefits. You know, my husband's a federal worker. We've missed paychecks. People are hurting. People are missing paychecks, and there's real consequences to this.
Well, the minority leader, I think, was also referring to the optics here of the president with the Argentine bailout, the building of the ballroom, the demolition of the East Wing, and whatever is going to come from this trade meeting tomorrow with President Xi. Roger, is this a good look?
First off, thanks for having me. And it's wonderful to be on with Annalise. It's a temporary kind of constellation of optics that I think play to the detriment of the White House. I could make a joke that if the shutdown goes on much longer, I mean, maybe the bulldozers pull over to the West Wing too or something, who knows?
That's going to happen.
But I do think the next 10 days will be pivotal. And the way I see the pressures kind of playing out, if you look at the government employees union peeling off, and then you look at the premiums that are now coming out in 2/3 of the states with more information coming. I think the pressure on the Democrats is going to come from inside their coalition, and I think the pressure on the Republicans is going to come from outside their coalition, with a couple exceptions, for example, Marjorie Taylor Greene.
Yes.
And then I think on an operational level, the conversations that really are going to matter are on the second tier below leadership. So it won't be the Thunes, it'll be the Barrassos and the Kanes and the Warners and maybe the Angus Kings that don't have the public burden of leadership and have a little bit more room for these conversations.
Sure.
Because the politics of this are such that the Republicans still, to this day, don't have an answer for what they want to replace Obamacare with. So in a sense, they could hold the line and then give some kind of concession towards maintaining the support for the subsidies for another year, which would answer then the question of what do we do when Obamacare goes away. And of course, the Democrats want SNAP and everything else to go back to level funding, et cetera. So there's a way, if you got everyone together, that the politics of this could actually play out well for both sides.
Really interesting. There's your 10-day plan from Roger Fisk. Others have suggested
for free.
That was for free. Thank you. That an air traffic controller walkout would end the shutdown that same day. Are we in store for a move like that?
I don't know. I mean, I think it's difficult. I've seen some flights that have been grounded and some issues across airports. That pressure is absolutely going to ratchet up, especially if we get into the Thanksgiving holiday. I mean, people are really going to be feeling the pressure. I want to key off on Roger's point, though, about some of the more rank and file senators getting together to find a solution here, because I think that's a great point. And something that has been interesting to me is how the Senate has been recessing for weekends. And a lot of times what builds some of this pressure, unfortunately, is locking them in the chamber and making them vote. I mean, they voted 13 times on a measure to reopen the government. But, sometimes you need that pressure of the Friday, the Saturday, the Sunday, not going home and then coming back kind of refreshed.
James Langford's bill keeps them from using taxpayer money to travel. So you're truly locking them in Washington, to your point, might generate some reaction. This is happening, by the way, as the president is abroad. Chuck Schumer keeps reminding us that the president is in Asia, and although I guess he could use the auto pen if he needed to, Roger. But let's talk about
all presidents
this meeting.
do, by the way.
That's true. This meeting takes place 10 p.m. Eastern time. What kind of a gift does President Xi need to bring Donald Trump? I mean that literally.
First off, I'm rooting for the president. I'm still old-fashioned. Whenever I'm abroad or whenever the president's abroad, I'm still rooting for them. That said, both Putin and Xi are very astute when it comes to what motivates the president of the United States. And Putin appeals more to personal flattery and plays, derogatory comments about the media and things like that. Xi knows that every bone in the president's body is going to want to walk out of that room and announce something immediately.
Yes, right.
Which, in real diplomacy, you usually just reference kind of progress, et cetera, because you never want to get ahead of a massive diplomatic affair. But it's going to be something surgical, and it's going to be something that the president can turn around and announce, for example, a large purchase of soybeans in exchange for the chips or some kind of access or a willingness to have conversations about this. The president does this quite often, for example, in the first term when he suspended military actions or exercises with South Korea before he walked into the talks with Kim Jong-un. So the question really is like, how prepared can his team get him, and how much can they get him to realize that sometimes being somewhat restrained in terms of his appetite for the optics and the announcement of a big deal the second he walks out that door might actually play better for him in the long run.
That's really interesting. What's your thought on this Blackwell chip from NVIDIA suddenly being on the table? Democrats and Republicans on this show this hour have questioned this with regard to national security. Is this a bad idea?
I think there are real national security concerns, and to ensure that we remain ahead in the AI innovation space. So, I think that we need to be careful with what we're offering and how we're playing that. I think I agree with Roger here. I think Trump is going to want to come out and be very proactive with he's already teased this deal, right? He said, I think everyone's going to be very happy. There's this framework. He's speaking very positively about this. So, I think we will have to see what the contours of this actually look like. And if they do include something that gives American innovation and gives an edge to China, I think you will see a lot of Republicans and Democrats sort of echoing the calls that you heard earlier with concern.
We're out of time, Roger. If China gets the Blackwell, did Donald Trump win or lose?
Short-term win, long-term loss.
Fascinating. We're going to find out together here in the next couple of hours. Roger Fisk and Annalise Keller, thank you both for your analysis and a great conversation. And we thank you for joining us on Balance of Power. We'll do this again tomorrow with a lot more news to report. That meeting will have just concluded when we get on with things on Bloomberg surveillance. I'm Joe Matthew in Washington. This is Bloomberg.
This has not been a great time for genius. The people who claim to have it do not seem to qualify for it. The people who diagnose it others seem to have a very, very narrow definition in mind. And the people we can all agree are stone-cold geniuses always seem to have a dark side. I read in Bloomberg Businessweek about the biggest crypto genius of them all, Sam Bankman-Fried. At his peak, he was worth like $26 billion. And that was before he was accused of running one of the biggest frauds in American history. His defense is that he is not a criminal, essentially, just inept. What does it mean to have genius in work, in the marketplace, in life? And who is even to say? To make anything simple takes actual genius, and we're going to try to live up to that name together tonight. It's the Business Week Show. Hello, I am Max Abelson, and I'm not a genius, just a regular, like slightly above average journalist who has spent about the last decade and a half here at Bloomberg News, and sometimes our magazine, Bloomberg Businessweek, writing about Wall Street's money and power. And what that means is I write about ambition and ownership and imagination and survival and risk and second acts and, of course, genius. Tonight, and in the weeks to come, we are going to be talking about those things at this table with people whose lives and careers and ideas are big or interesting or just really fun. So, welcome. This is the Business Week Show, and it's starting right now. If you consider yourself a master of Wall Street, a connoisseur of investing, a soothsaying financial genius, a brilliant portfolio manager, our guest has very bad news for you. Burt Malkiel's book, A Random Walk Down Wall Street, 50 years ago, had a clear and vivid message, which was that Wall Street genius is really just an illusion, and that professionals in pinstripe suits, at the end of the day, are no better than naked animals. It was a genius and radical idea, because what he had to say is that you should forget them and just buy and hold clear, boring, basic, low-cost index funds. He is here to tell us about it. Burt Malkiel, welcome to the show.
Thank you very much. Glad to be here.
Your book is actually, it's pretty funny. It's a little saucy sometimes, your book. I mean, you say no one in finance can really forecast the future, or at least they can't do it successfully, consistently. You know, I think you use the word genius in quotation marks, and you give it to Ponzi schemers and whatnot. Right now, are there any actual individual geniuses on Wall Street? You know, real human geniuses, maybe AI is a genius we've been all waiting for. Can you identify any current geniuses on Wall Street right now?
Well, as you know, I put genius in quotes because I'm not sure there are geniuses in the market. And I've always said I would much rather be lucky than smart. Are there some hedge fund people who have, in fact, made a lot of money? George Soros bet against the British pound and made a lot of money. There were people who sold short in 2000 and made a lot of money. But I am not willing to say that they were geniuses. I want to say that they were lucky, because for every one of them, there was a hedge fund that in fact lost money. No, I don't think there are geniuses. I think there are a lot of very smart people on Wall Street, but it is not possible to predict the future. And, you know, it's kind of very interesting how you talk about AI. I recently had to give a presentation on the economic outlook. And I thought, you know, just for kicks, I will go to ChatGPT and I will ask, can you give me an outline of what I should say? And actually, ChatGPT gave me a wonderful answer. It was a one-sentence answer. I cannot predict the future.
It might not necessarily qualify as genius, but you're able to write about Wall Street with clarity, which is really unusual because Wall Street, and I suffer from this myself, you speak to Wall Street executives and they absolutely fetishize complexity. Why does Wall Street like to make things sound so complicated? Is there something sinister or something that has to do with the ego?
Whether it's sinister, but this is a very highly paid profession. And someone like me who says, listen, don't listen to anybody. Just buy a simple index fund and keep on investing period after period. If I'm charging you 2% a year to manage your money, I want you to think you can't do it yourself. So sure, you've got a vested interest. This is a very highly paid profession. These guys do very, very well. Is that sinister? I don't know. You call it sinister, anything you want, but is there an incentive to make it seem like it's very complicated, that ordinary people can't do it themselves? I think that's absolutely right.
The honest truth is, it's not necessarily that I think that the aura of complexity on Wall Street is coming from a sinister place. More like it makes me feel bad or makes me feel dumb, and that I appreciate that your book is sort of written so that I can understand it. But it does make me think about exclusion in a small way, because so many stocks are owned by so few people in this country, because the very wealthiest people in America have such giant portfolios, that when the stock market goes up, inequality goes up too. Is there anything that can be done to change that in the future?
One of the things that's impressed me throughout my life is really how capable so many people are. And I think to the extent that we can eliminate discrimination, I mean, for example, opening up our jobs, our economic opportunities to women has been a very good thing, and I think has been generally helpful for women. I think it's the same sort of thing in terms of racial discrimination. I am absolutely convinced that rather than there being just a small coterie of geniuses, that intelligence is very widely distributed in our population. And so my own sense would be the more we can do with education, the better.
Why is it that we need geniuses, or really just the concept of genius? Is it like the way we need heroes and heroism, to help just explain the world and justify?
I think we need innovators, and I'm not saying that innovation isn't good. We absolutely do, but I'm not going to call them geniuses. And Jack Bogle would certainly never have called himself a genius. But I think we do need innovators. There will undoubtedly be financial products that are actually good for one. I'm not a fan of Bitcoin. I don't think, I don't recommend that any investor buy it. But will there be improvements in the payment system in the future? And will there be digital currencies in the future that are stable and that are useful, as opposed to something that goes up $1,000 or down $1,000 in a day? Absolutely. And there's room for much more innovation in finance. So I think there will be innovation. There should be innovation. I just wouldn't call it genius.
That was great. Burt Malkiel, thank you so much.
Thank you so much. I really enjoyed our conversation.
Stay tuned, because next we have a very far out genius. There is no one way to be a genius. You could be dreamy and far out. You could be scrupulous and scientific. You could work within the institutional establishment, or you could honor indigenous wisdom. All of those descriptions apply to this guest. Moraba Jah is a space environmentalist, an astrodynamicist, a spacecraft navigator, and the first African-American professor of aerospace engineering at the University of Texas. Last year, the MacArthur Foundation gave him a fellowship that is informally known as a Genius Grant. So, if you want, you could call him a genius, you could call him Professor Jah, but you'd rather you call him Moraba. So, Moraba, welcome.
Great to be here, my brother. Thank you so much.
Really glad to have you. I really love the phrase, a stroke of genius. You were in Alaska with your family in a hotel one morning. I think you were taking a shower.
Yeah.
And you had this feeling and this vision that kind of struck you. And you know, whether or not it has anything at all to do with genius, tell us about that moment.
You know, I'm in the shower, and I felt a presence. And in my mind's eye, I saw flashes of scenes from like history and how in the beginning, whatever that means, it seems like there was this intergenerational contract of stewardship with the planet, but that humanity over time has mostly abandoned that intergenerational contract of stewardship and has forgotten about how interconnected things are.
Did that moment change the life you led and the work that you do?
Absolutely. So one of the people that I really look up to is Jane Goodall. I watched something about Jane where she said that she went to a meeting as a scientist and she left that meeting an activist. In very similar ways, I went to Anchorage kind of just this scientist, and I came back both a scientist and now this space environmentalist activist to really try to, I guess, really showcase how we need to protect orbital space.
If there's a kind of genius that means something to you, something that you would want to live up to, or something you'd want to recognize in yourself, what would that kind of genius like actually look like?
To me, the best kind of genius is simply allowing myself to let the universe go through me and, I guess, use me as some sort of vehicle for the work that I'm trying to do. And if I can keep myself kind of in the moment and in a place of compassion and empathy, then I think genius is just what comes through when you allow that to happen.
There's more garbage orbiting the Earth than there are working satellites. You now work not just to make sure that all that stuff is properly tracked, but to be an evangelist for expanding the way we think about environmental protection so that it includes all that stuff. What can those of us who are not scientists, what can we do to help you?
Every day, the technologies that we have are more and more reliant on these robots in the space that we call satellites. And we're tracking about 50,000 things ranging in size from a cell phone to the space station. 5,000 are working and everything else is garbage. So that's like 90% of the stuff is trash. The thing that most people just don't realize is that these satellites that are providing these critical services and capabilities, position, navigation, timing, communications, internet with the Starlink satellites, right? Any of these things can get schwacked, that's the technical term, get schwacked by a piece of junk, and that's game over, and then you lose that capability. So I think more and more people just need to be aware that, oh, well, that space, that's somebody else's problem. No, it's our problem because our way of life, our technology is now going through this infrastructure.
There's a real stereotypical idea of genius that I'm thinking of a kind of solitary genius working by herself or himself off in a fun cabin, you know? What does it mean? What would it mean to be a genius collaborator?
Back in the times of like the Renaissance, people looked at folks like, Da Vinci, Michelangelo, and they said, okay, these are geniuses in their own right, right? And people say, well, how can anybody be like another one of those? Science has developed so much beyond those days that there's no way for somebody to be able to be, quote unquote, this Renaissance person that knows very deeply things in all these different fields. Like, those days are gone, okay? But to me, the real genius is recognizing where you bring in smart people from other fields that complement and augment your own to solve wicked problems.
Yeah, connectedness, connections with one another. But my understanding, though, from reading a little bit of your writing, is that you were, I think in your childhood, you felt really isolated.
I did, yeah. My mom was born in Haiti, and she was naturalized citizen. My father, Sierra Leone, naturalized citizen. They got divorced when I was very young, and my father was just very abusive. So at the age of 7, he kidnapped me, and 9 days later, they found me in some apartment in the Bay Area, put me back on a plane to my mom, and my mom had, we had a cousin that lived in Caracas, and so we fled the country because my mom's like, I don't want your father to ever find you again. He never did physically again. But growing up in Venezuela, I felt very isolated. I felt very alone. I came into contact in this void with what seemed to feel like an ocean of infinite love and compassion. And then I realized, I have a choice here. I can choose to meet my experiences with equal anger, or I can choose to act from a place of love and compassion and heal from my pain and make my healing be of service to others. And that's what I've chosen to do.
When the MacArthur Foundation, when they named you a fellow, they said it was because, they used a beautiful phrase, it's because you envision transparent and collaborative solutions for the Earth's orbital spheres. What are those solutions? And maybe when are they coming?
My inspiration for this comes from indigenous people, from traditional ecological knowledge, TEK, I call it ancient tech. And so for me, the vision of my future is seeing Western science and traditional ecological knowledge come together, not annihilate each other, but actually harmonize with each other, so that then that could be the way of the future, so that humanity does recognize interconnectedness, empathy, and stewardship.
Thank you so much for being here and sharing your story, sharing yourself.
Thank you, brother.
Truly enjoyed it.
Thank you.
Coming up next, a genius I would like to be when I grow up. Getting older is not easy, but the good news is time brings opportunities to become a more practiced, a more seasoned, a more you version of you. The guest who's sitting with me at this table is one of the most accomplished people I've ever met, and she is 17 years old. In 2021, Zaila Avant-Garde won the Scripps National Spelling Bee. But she considers herself not so much a speller as a basketball player, and she has multiple Guinness World Records in juggling. A few weeks ago, this young genius started the 11th grade. Zaila, so glad you're here.
Thanks for having me.
Truth is, we're all super different. We all have our own gifts. We all have our own limitations. When and how did you come to realize how special you are?
So that's a complicated question, I would say, because I didn't so much realize, I realized I was special, but I became special through a process of like training and stuff. If you look back on it, like I wouldn't say I popped out the womb like a genius or something like that. It's like when people would start to stop and look at me while I was dribbling or practicing at a court, people like stop and look because, hey, look at this cute little girl. I was very small when I was that age. So this cute little girl dribbling 2 balls and doing all this between the legs, step backs into shots and stuff. So pretty early on, I realized that, yeah, I might be a little bit different than the average kid. You won this like completely beloved national competition, but it's something that I think you no longer consider your main passion, or maybe you didn't even consider it your main passion then. What does basketball make you feel that spelling doesn't? I would say basketball gives me even more of like the competitive rush. Like I just really love to compete and stuff. So like, and like spelling is more like, yes, it's not really like person-to-person competition. It's more like person versus dictionary, which is something you hear a lot from spelling bee people. It's like it's me versus the dictionary, because that's where the words are coming from. Whereas with basketball, it's more like physical competition. Like, oh, I made it between the legs, and there's this girl on me, and I have to shield her off. And it's like more tangible competition, as opposed to the more philosophical competition of spelling. I want to ask you about a very different kind of genius. There's this billionaire named Sam Bankman-Fried. I think you've heard of him. Of course. Widely considered to be the world's, great crypto genius before he was then charged with fraud, which he has denied. How should the rest of us look at people who get called geniuses, but maybe they still have shortcomings, just like everybody else? Sometimes I feel like the term genius is like nowadays it's so loaded. Like it's not, maybe it's like, oh, it doesn't just mean, oh, look at her, she's a genius, like she's so smart or whatever. But like then like if you're labeled with that like your whole life, that kind of like puts a pressure on you. Like maybe once upon a time, like I listened to a podcast about Sam Bankman-Fried, but I don't know him personally, so I can't speak for him. But hypothetically, like he's like his parents are like, oh my God, you're so smart. He goes to accelerated programs in school, and that's just putting pressure from a very early age. Like I'm a genius. I have to be a genius. I have to always be a genius. So I always feel like people like some of the scammers and stuff should get maybe just a little bit of sympathy, just a little bit, because they are like causing all sorts of trouble, because like they've been considered geniuses their whole life and they had a nice business plan or something, but then it didn't work out. And so what are they supposed to do? Go to all these people who say, oh, you're a genius. That just puts a little pressure on you to like give you that extra push you needed to try to maybe go into the murky waters of life. The murky waters of life. I want to ask you one final question about pressure. I think that there is sometimes pressure in the United States, maybe everywhere, pressure on really smart people, genius or otherwise, to use their intelligence to like make a lot of money, to be successful. And like I guess I'm thinking specifically about the finance industry and mathematicians, but it's true of the business world. You're smart, you go make money in business. Do you have a favorite company or an industry or like a job that appeals to you? I mean, I'm not like super like make millions of dollars. I mean, if anybody who's watching or listening wants to give me millions of dollars, please hit me up. However, like I'm interested in going to neuroscience or maybe working for NASA or maybe being an NBA head coach. But I just realized I've never thought, how much money would I get for this? Because that's not really something like I think of, because you can make a lot of money, not to sound trite, but you can also be really miserable making a lot of money. So that's not even something I actually consider, like how much money will I make? I'll cross that bridge when it comes. Zaila, you're gonna cross the bridge, you're gonna have a great time. I have had a great time talking to you. I'm thrilled you're here. Thanks for having me. When you ask geniuses, as I just did,
what a genius is, or if we need geniuses, or if they're a genius, the answer you'll get will be genius. It turns out that there is not one way to be a genius of finance or of art or of language, just as there is not one way to think about genius itself. What matters is not what you call unusually high levels of intelligence or talent. What matters is what you do with it. Thank you so much for watching the first episode of the Business Week Show. We'll see you again for another one soon.
I am a completely virtuous person. I have no missing virtues. But I do wish I could sing.
People clearly tend to be impatient where they should be patient.
I waste the most money on champagne. I love champagne every day. Every day I have 2 glasses of champagne. That's my thing. 2 glasses of champagne every day.
Risk is everywhere. It is a risk to get out of bed, take a sip of coffee, step into the street, shake someone's hand, eat a tuna melt. Trust risk betrayal, authenticity risk rejection, and if you want to play it safe, doing nothing risks missing out on everything. We associate risk with what you might lose, but there is no winning in the marketplace without it. If anyone ever comes up to you and offers you something that is completely risk-free, buyer beware. Nothing ventured, nothing gained. I read this thing in Bloomberg Business Week about Silicon Valley Bank, which bought billions of dollars of bonds, a risk, and the value of those bonds fell, depositors went running out the door, and the impact of that risk was one of the biggest bank failures in the history of this country. What does it feel like to take risk in business and in life? We're gonna try to find out from actual risk takers. It's a risk, we're gonna take it together, and we're gonna take it tonight.
It's the Business Week Show.
Welcome to the Business Week Show. Tonight, risk. The very idea of who gets to take financial risk in global markets and how they go about taking that risk, and then how they talk about that risk, changed thanks to tonight's first guest. In 2012, Jamie Rogozinski logged onto Reddit, he started a new page, and he called it Wall Street Bets. In the years that followed, it got millions of users. It sparked real frenzies in stocks like GameStop, and AMC, and at one point it got its own Super Bowl ad. But as you may imagine, things did not work out all that well for everyone, and Jamie is here tonight to tell us all about it. Jamie, seriously, thanks for being here.
Thanks a lot for having me.
Risk is a funny thing because it freaks some people out, me included, but there's also something about it that is so attractive and so tantalizing. Why have you been so drawn to it?
Risk is a funny thing because when people say risk, especially when you frame it that way, the implication is either there's an element of randomness, right, or that's the outcome can be very, very costly because it's either unlikely to pay out or the actual, chance of losing might be really costly. But the way that I see risk is really, if you're able to actually quantify those elements, it's really a price that you pay for an opportunity. The way that I look at risk in that sense, it's not that I'm attracted to these thrill seeks. It's, I think this is worth it, right? I think I can identify these are the probabilities or possibilities, and sometimes I can't, but at least I can map them out. And this is what the possible outcome is. And I'm like, let's do this.
Okay, let's do this. Let's really talk about that. Because what you're saying is you're really talking about what it means for something to be risky. When you started Wall Street Bets, the way you've talked about it is that you said you wanted a place where people could talk about risky ideas and they could talk about it kind of proudly, risky trade ideas. You were enabling other people to take risks. So can you tell us, like, what worries did you have at the time that things potentially could go wrong for them?
You know, my definition, my understanding and my position on risk has evolved, right? It's become clear as the years gone by. And early on, I justified this by saying, well, look, they're all adults. You have to be 18 in order to open a brokerage. Same thing if you go to a casino, everyone can go through. And when I said I wanted to be able to discuss high risk, I wanted to discuss high risk, high return, right? It wasn't just high risk is throwing your money out the window and having it go away with 100% certainty. This was high risk with the possibility of making money. And those two obviously go hand in hand. There are some that are irresponsible with it, but I can't make myself responsible in much the same way that there's gambling addicts, right? But outside of that, what I start seeing is a learning process, much like the one that I personally went through. I lost tons of money, but I walked away with so much knowledge and understanding and hands-on experience that a textbook can never explain to you.
I want to ask you about someone who sort of counts as your really, really complete opposite, Jack Bogle. He was the founder of Vanguard. He helped popularize the very vanilla, very boring idea that if you're an investor, you can diversify your bets. He ended up popularizing the index fund. How did it feel that you, in some ways, were kind of singularly responsible for changing the way that just millions of people think about investing? What did that feel like?
It was humbling for sure. It was unexpected to see the enthusiasm. If I were to have predicted the outcome of it, it would have been people looking down at this particular type of activity. Secretly, it was almost a goal of mine. But the beauty of it is what conservative investors do, Bogle, Buffett, whatever it might be, is no different than what gamblers that literally go to sit at a roulette table do. The changes in the vision that Wall Street Bets were, it demystified the idea of finance to people that might otherwise think it's just Excel sheets and discounted cash flows.
You also took a different kind of risk and you sued Reddit and you lost. Will you tell us a little bit about what that felt like?
Terrible. Yeah, that was probably in the top 5 riskiest things, if not 3. I get kicked out, and the stubbornness behind Reddit, they never answered. I tried pleading and sorries and threats and back channels and lawyers. They would just be like, no, you're done. They got to a point where they said, no, we're done trying to negotiate. We want to take you to court with this. And I said, all right, well, I guess now I have to actually go to court. And so this is when I decided to countersue them.
So
and
it didn't feel like a risk. It felt like just something you had to do.
I needed to do a foreclosure. I still had a chip on my shoulder, and I couldn't fully commit to anything. And I'd still kind of look at, every time I'd see Wall Street Bets on the news or people talking about it, it would still have that kind of sour feeling. And so, and I needed to get past that. And I'm like, look, if I lose, I lose. And then it was it is what it is, and it would have been the fight of the century for me, or my lifetime for me. But then I can be at peace. Right?
Is that how you feel now? Are you at peace?
Unfortunately, not, because it's not over yet. I would have liked I would have liked for the judge to have been like, no, dude, you lose and it's over. You know, I don't want to comment too much on the legal side of things, but the judge, let's just say they left plenty of room for maneuvering. So unfortunately, it's not over.
I was told, I really don't know what it is. I was told you brought an object, I think, that maybe encapsulates risk. I think Natasha, my colleague, is gonna pass it to us, I do believe. What is this? Okay. All right. Tell us about this guy.
You're familiar with this?
Yeah. Remind me.
So this is from a meme, right? It says, "This is fine." It's a little dog, and this encapsulates so much of both my life and my ability to handle emotions, especially with the volatility of markets, but also life in general. It gives you so many ups and downs and so many ways to go through it. Oftentimes, when faced with adversity, my composure resembles this. It's like, yeah, don't worry about it.
Can I see him?
Okay. Yeah, absolutely.
All right. Well, this is mine now. Jamie, thank you so much for being here. Loved having you.
Not a problem. Thank you very much for having me.
We have more risk coming up next. When executives across corporate America want to take a little risk or manage it, they often turn to Wall Street. And there is no entity on Wall Street with a more interesting relationship to risk, including Wall Street bets, than the company Goldman Sachs. And when I think about Goldman, which I do often because I'm a Wall Street reporter, my mind often turns to Maeve DuVally. Maeve is a longtime media executive and until recently was a managing director at Goldman. The truth of the matter is, we have a cordial relationship, but a kind of antagonistic one because it's my job to report on Wall Street's money and power, and it's her job to push back. Recently, I finished her wonderful memoir, Maeve Rising, which is an account of her journey from being a lonely and angry person to the woman who is sitting at this table with me right now. Maeve DuVally, welcome.
Max, thanks for having me. You know, I would say we don't have a antagonistic relationship. I would say that we've locked horns through the years.
Okay,
is that a better characterization?
I think that's a better characterization, but I'm going to ask you in just a couple of minutes about all kinds of risks that you have taken, personally and professionally.
Sure.
But I feel like we should start first things first.
Yep.
Why is risk, which is really, I mean, it's just a fancy way of saying basically the things that can go wrong. Why is risk so important to the work that happens on Wall Street?
Well, from a market perspective, obviously managing market risk, managing operational risk that somebody pushes a button they're not supposed to, and the trade that happens is bigger than it was supposed to be. Those are obvious risks. And there's also kind of macro risk, right? That a central bank does something that people weren't expecting. But the kind of risk that I manage, and incidentally, everybody at Goldman Sachs is taught they have to manage, is reputational risk.
Okay, so I want to talk about 2018. I think my favorite page of your book. You put on makeup at the office for the first time. What I really want to ask about is, tell me about the day. What do you remember in full about that day in 2018?
Well, it was the day of the Knight Bagehot Fellowship dinner, which you've probably been to. Knight Bagehot Fellowship is a fellowship for mid-career financial journalists at Columbia University. I'm a alumni of that program and also on the board of Knight Bagehot Fellowship. It's really a nice gathering. I usually look forward to the dinner, but sometime early that afternoon, I literally had this overwhelming feeling and desire that I needed to wear makeup to the event that evening. And once I had that thought, I couldn't get it out of my mind. And I bolted out the door and walked a third of a mile to the closest Sephora and bought a bunch of makeup, which I put on at the end of the day. And I went to that dinner with some makeup on for the first time.
You put on the makeup, you end up kind of negotiating with yourself. And you say to yourself that you basically have this barrel of femininity, and you think should I just keep the lid on? Should I just keep the lid on? What would you have risked if you had done that?
I think that would have been impossible, but if I did that, I would have been miserable.
I was wondering when I read your book how it felt to kind of risk your male privilege. You were risking your male privilege in a male-dominated industry.
I'm certain I had male privilege, and I'm certain through the years I exercised male privilege, but I wasn't really consciously aware of it. And to be perfectly honest, it's not something that really matters to me.
When it's time for you to choose a name, you pick one that means she who intoxicates.
Yeah.
Which blew me away when I read it, because months before, you stopped drinking. You stopped drinking. Why did you quit?
Well, I had a series of progressively bad bottoms. My last bottom, which was in January of 2018, I holed myself up in an apartment. I only left to get alcohol. I drank around the clock, and I made an attempt on my life. So if I continued drinking, I'm convinced that I would have killed myself. After that episode, I made a decision that I wanted to live. And I knew if I wanted to live, I had to stop drinking.
Look, we have a professional relationship, so part of me feels like it's hard to say this, but it's also hard not to say it. I'm glad you made that decision. A lot of people who are miserable, they don't get out of their misery.
Yeah.
They stay there.
So the reality is there are a lot of drug addicts and alcoholics in the world, and the vast majority of them do not get sober and do not get clean, and they die alcoholic and addict deaths. That's the reality. So those of us who have made it to recovery, don't take it for granted, number one, and two, realize that it was a gift. And it's a gift that has to be nourished all the time, because if you take it for granted, you're going to wind up right back on the street.
When you came out, you got, I think, literal bouquets from traders at Goldman. I think you got these very warm notes from people. I think you got phone calls.
Yeah.
Those were from traders, and they were not from investment bankers. And you write in the book with clarity, investment bankers were quiet. I was so surprised by that. Can you explain that? Why did that happen?
I think probably some of my relationships with investment bankers were shallower than I thought. And I think investment bankers are very good at having really expansive relationships kind of across a wide group of people. But maybe some of those relationships aren't as deep as they would appear.
I love that you're accusing investment bankers writ large of a certain kind of interpersonal shallowness. I hope
I'm not sure I said it exactly
well, that is exactly
way.
as you said it. No. I'm hoping that you'll...
You're not going to put words in my mouth, are you?
Well, I'm the interviewer now.
Yeah.
You know, I asked you earlier about male privilege. Coming out as trans in the milieu of, first of all, New York City, where we are, but also a corporation which I'm sure, as I'm also keenly aware, has a lot of pressures too. Can you talk, if you want to at all, about, I don't know, maybe the kind of privileges that come with having a really good career as you do?
Sure. So I certainly have white privilege. I have the privilege of having worked at Goldman Sachs. I'm relatively well off. I live in the Chelsea section of New York, which is arguably the best place to be an out transgender person in the world. And even before I left Goldman Sachs, I began to, and I've continued to be, an advocate or activist for the LGBTQ community more broadly, because not everybody is in a position to speak out. Not everybody wants to speak out, but I'm in a position to, and I want to speak out, so I'm going to.
Thank you so much for being here. I really enjoyed this.
Thanks for having me, Max.
If the names RZA, Jizza, and Old Dirty Bastard mean anything to you, or if you've ever been moved by the music of A Tribe Called Quest or D'Angelo, then you owe a debt of thanks to Sophia Chang. As an artist manager and as a music label executive, she helped shape the landscape of a golden age of New York City rap in the 1990s in a way that would be totally under-celebrated if it weren't for her own book, which is called The Baddest Bitch in the Room. It's a book about the music business, but it's also a book about taking risks, some that work out and some that don't. We've talked tonight about personal risks. We've talked about professional risks. We've talked about financial risks. Sophia's story is a story about what happens when those things come together. Sophia Chang, welcome to the show.
I am so excited to be here. Thank you, thank you, thank you.
You manage Old Dirty Bastard without any experience as a manager. You ran RZA's record label without any experience running a record label. I think you say in the book that risk is in my DNA.
Did I?
You do.
I wonder if I plagiarized that from somebody. That's really clever.
Risk-taking was in my DNA. Sophia, why is that?
I would say certainly my parents' stories have a lot to do with that. My mother, Tungsuk Chang, born in 1932, she escaped North Korea when she was 14. She was one of 10 siblings. That was a huge risk. It was a very risky boat ride. My father he was, God rest his soul, he was estranged from his father, and he took a risk when he studied mathematics in Vancouver. They went to Canada to build a better life for their family. So none of that was explicit in my head as a child, but I think that that's probably the model. And I think the other thing that really supported my journey and my risk-taking was that my parents, every move that I made, they encouraged me. After I moved to New York, I didn't have a job. I didn't have a place. Their peers would say, your daughter, what's she doing? Get her back.
They would have had a good answer, because when you moved to New York, I think one of the first jobs you had was working for Paul Simon.
Yeah.
Paul Simon had a personal assistant who I think was a Korean-American woman.
That's right.
And I think she taught you almost explicitly that it was important for you to take up space in a room. How is, not just confidence, but something like unapologetic confidence, how is that a risk?
I think when you take an intersectional view of this, right? When you think about the fact that I am a woman and I am Asian, and I mostly navigated, Max, very male-dominated milieu. And yes, I remember, her name is Sonia Che, God rest her soul, and I remember watching her move, and I thought, wow, and she would just, and she was smaller than me, she would just burst into a room and you could just feel her. She didn't have to yell, she didn't have to do any of that, but her energy just emanated off of her, and I really took that lesson from her.
But, it occurs to me that you talk about losing the fear of embarrassing yourself.
Yes.
I think when you're at like Atlantic Records in an early job.
Yeah.
People have a fear of embarrassing themselves for a reason, because it's self-protected. It's a kind of shield.
Yeah.
So it occurs to me to ask, maybe the question I really want to know is why is it so risky to be yourself?
I think that in general, we as humans operate out of fear. Just in general. So if we're in a meeting and there are 10 people sitting around the table, and maybe I'm junior and I have an idea, my fear, and even if I think it's so smart, my fear is I open my mouth and everybody goes, and it's like the record scratch, rewind, and then everybody looks. I think we all live with a real fear of humiliation, embarrassment, excommunication, reprisal.
Right.
So I have gotten to the point where I just don't care. I mean, it's so incredibly liberating not to care what other people think. It doesn't mean that I don't get my feelings hurt. For me to be out here speaking as openly and fearlessly as I do, I know from people who come up to me that I'm setting an example.
One way of thinking about risk is that it's a kind of bet on the unknown.
Yes, of course.
It's a way of endorsing one kind of future over another. What are the risks, or maybe a single risk, that you still want to take?
I feel like I take risks all the time. I feel like my life is full of risk, and that does feel reckless, but I just turned 58, and I want to fall in love again. And that's really scary for a woman over, that's scary for a woman over 35. Never mind a woman over 40, over 50, close to 60. And what does that mean for a woman of a certain age to want to fall in love again? Well, that means you've got to put yourself out there. That's a risk because of patriarchy, because of ageism, because of all of those things.
Well, I wish you love, and I wish you many happy risks.
Thank you.
Sophia Chang, seriously, I loved having you here.
And I love being here. Thank you so, so much. Thank you.
Tonight, our three guests, with three very different careers, showed us that you can take just about any risk you want at work and outside of work if you've got the risk appetite and you're in the market for it. You can create a mechanism for other people to take all sorts of outlandish bets on stocks and options. You can reintroduce yourself at your very fancy job without a guarantee that your colleagues are going to appreciate the change. You can take a job in a big business that you're not really qualified for, and then if you don't like it, you can leave. What you can't do, according to these three interviews, is know for certain what the payoff's going to be before you take the risk. The best you can do is think carefully about the risks you want to take, think about why you want to take them, reconsider the risks you've taken already, and wonder about the risks that are still to come. Thank you so much for watching. We'll see you next time.
The biggest and most consistent lie that I've told in the workplace is telling my clients and or members of Wu-Tang Clan what time the lobby call is or what time the flight is and making it an hour earlier than it actually is. But they all figured that one out a long time ago. So you just have to keep moving it back.
In terms of what causes me the most anxiety, it's when a news story I worked on didn't quite turn out like I planned. That's when you can get into trouble, when people have an unexpected negative surprise.
What's the worst thing that I've ever done professionally? Oh man, these existential questions, what is bad? There's nothing that I can recall that was not moral or not ethical. Mistakes, on the other hand, I've made plenty of those, but all of those have been good, right? They were all stepstones to succeeding, to being able to creating, to be able to actually fulfilling stuff.
I wouldn't say that I've had one sweeping gesture of generosity, you know, and you got a car, you got a car, you got a car. I've never been in that position. What I do that manifests generosity is telling people they're doing a great job and always giving them credit when it's due. And it costs nothing.
Welcome to the Business Week Show. When my colleagues and I thought about what kind of themes of the magazine we want to turn into episodes of the show, we spoke about envy, failure, feuds, family, heists, generosity, legends, risk, rivals, and then we had a really far out idea. Moonshots. We reached out to many different kinds of people, including like actual real NASA astronauts. The first person that we talked to is a billionaire who is spending $100 million to try to cure a rare kind of muscular dystrophy that he has called FSHD by the year 2027. His name is Chip Wilson. He's the founder of Lululemon, and that is one of the most valuable apparel brands in the world today. But when we heard about his life and his career and his feelings about honesty and one extremely serious example of dishonesty, we decided to shoot for the moon. So, tonight's episode is built around one interview and built around the moonshots of one person who doesn't totally think they're really moonshots at all. Here is Chip Wilson. Chip, welcome to the show.
Well, thanks for having me, Max.
You've written
about feeling kind of disgusted in business and in life by, I think, what you call mediocrity. You know, and that's like complaining or caution or like wallowing in embarrassment, wallowing in shame. What you want instead is, I think, what you describe as a kind of like radical, a radical greatness. What has the idea of moonshots meant to you and to your career?
I never really thought of moonshots ever. Like, so, I mean, you're bringing this up, and I guess Peter Diamandis from Singularity University and fame in the X Prize would have been kind of the master of this kind of idea about having an idea that could make $1 billion, affect 1 billion people in the world. And so what is that? And how do you exponentially set your company or yourself on that trajectory to get there? And of course, the big ways are setting a firm goal with a buy-win date and conditions for satisfaction, and then putting action in place in order to get there.
Am I right, though, even if you're not thinking about it as moonshots, am I thinking that sort of maybe your life has been built around this idea of really kind of loathing like an acceptance of mediocrity, and that what you want instead is to put yourself in a position to make kind of the impossible possible, which is, I guess, how I think about moonshots?
Yeah, I think more like I almost feel sorry for people that get to near the end of their life and they go, oh my God, my life is over and I really didn't go for it. And something that we'll talk about maybe later is this thing about looking at life from the stands rather than playing on the court.
By the year 2030, I think you've said you'll be unable to walk by yourself. You're about 18 months now into, I think there's a 5-year window for the $100 million US goal. Right. How is this new moonshot, if that's a fair word for it, how is it going?
I would say it's phenomenal. Before 2018, when we really started thinking about this Solve FSHD model that we have right now, myself and a man named Neil Camarda, who was the ex-CEO of Shell Oil in Canada, family also has this. We belong to a firm out of the Netherlands called Facio, and it was like the only thing dealing with FSHD in the world, and we went through about 6 or 7 years of it and $30–40 million, and nothing really came out of it. I got to the point where my muscular dystrophy was telling me like, oh my God, like I can't pretend like it's not going to happen anymore. Like it's really starting to affect me. So I went, okay, I've got to put some action in place to make this happen. And I had been studying Peter Diamandis' model about how to set up a $100 million prize and then what that does. And what it does is it brings everybody out of the woodwork. One, you get a lot of publicity for it. There's funding there, and people go, you know, I have an idea that I think can be attributed and help FSHD or maybe even cure it. But there was a lot of steps that had to get there to do that. So hopefully that gave you the foundation of where it came from.
You were diagnosed when you were, I think, like 32.
Right.
Which before Lululemon. I'm wondering if maybe an idea that there was something wrong going on, if that subconsciously put a kind of internal pressure to sort of be great in the years ahead, and that even if you weren't thinking about it, somehow it pressured you to do something like kind of extraordinary.
I would never compare myself to Steve Jobs, but I often thought about Steve, like whether internally he knew something was going on and he had to make things happen. I don't think that was necessarily it for me. I think I got diagnosed with it. I think I'm a very lucky person in that I have a very slow-moving one. There's thousands of children in wheelchairs who have it. I mean, and then I go, well, why was I so lucky to have a slow-moving one? I was always an athlete. I mean, like 3 or 4 hours a day my whole life. And so I think I was lucky to have this part of it kind of repress I guess the inflammation that occurs in the expression of the epigenetics of the expression of the DNA. So I feel like I've been very lucky to have been born with the athletic love, but on the other hand, I have this problem, and
I know that you consider yourself lucky, and I know that you like to think about yourself as a player on the field, and that you were a triathlete and you swam and you worked out, I think, like 2 or 3 times a day.
Sure.
Sounds very stressful to me. But I'd like to try to channel, if it's true, the feelings that the feelings that I live with, for no particular reason, feelings of like self-pity and anger or regret. The common sort of ugliness of life. Have you gotten in touch with some of those things over the last couple of years?
Oh yeah, I definitely lived that life a lot till I was 40, and I think that I did a couple of things. I mean, I went through that period of like self-reflection at the age of 40. Read 7 Habits of Highly Effective People, The Psychology of Achievement by Tracy. I took the landmark form course, read the book Good to Great by Jim Collins, and these things kind of formed a new Chip Wilson, so to speak, and it reframed who I was and how I was going to move forward. So I was able to like very easily now flex this muscle called amnesia. And amnesia is something where it's like waking up in the morning and I have no past. And if you have no past, then interestingly enough, you have no future.
Sing a slightly different tune in the memoir. You are very clear that you're really future oriented, and you describe kind of beautifully like this way of like you do kind of talk about like living in the future. And I associate that's one reason why I think about you in Moonshots. I'm curious to ask about the way in which you can put yourself in the future, and the way in which I guess your success has afforded you an ability to try to change your future. So I'm wondering if you still feel as future oriented as you used to.
Oh, I'm definitely there. I think the best way to affect life in the present is to determine what my future is going to be. So I set goals for 1, 5, 10 years out. I have a 30-year vision of what my life wants to, I want it to look like. And I work back from that 30-year vision to set my 10, 5, and 1-year goals. And I put actions in place in order to get there, and I get the life that I want to live.
Do you feel that you've ever been disappointed that the present doesn't turn out to be what you thought the future would hold?
I don't mind failing 50% of the time at my goals. I think failing is a muscle that very few people are used to now. And people talk about stress and mental illness. No, it's just a failure, and it's a failure to be dealt with. And I think people that learn how to deal with failure learn how to reset goals, reset conditions of satisfaction, new dates, and get on with life.
What's the connection to stress and mental illness? Do you think that sometimes people misinterpret what's really same?
Well, I mean, we've all heard of this thing called helicopter parents that have taken care of kids and doing everything for them. Never let them fail, never let them have any adversity. You know, I think that that's the worst thing parents can do, and I think we're going through an epidemic right now.
All right, but you know, that's ironic though, because it was your dad who told you, I think at a swimming pool, that instead of saving your energy in a race for like later on, the final laps, that you should go all out. Will you tell us more about the poolside theory that your dad gave you? And I'm pretty sure that it's important to your life.
Yeah. It's really critical. Everybody in that era, it seemed like in the 60s or 70s, it was kind of like, there was always this thing about looking good at the end of the race, like sprinting the last 100 meters in a running race, or in the swim race, going to the end and hitting the wall and going, but nobody really like went full out at the beginning. And of course, it's very common now in Olympics. You can see everybody doing it. But at the time, it was rare. And so to actually like decide to go full out and fully commit, you know, had me get a Canadian record. I think it was the #2 time in the world at the time. And I went, wow, you know, like what? So now I became actually fearful, which is kind of an interesting way of being, of going through life and doing things and not committing 100%. I never wanted to get to my deathbed and go, I only gave that idea 97%. If I would have done 3% more, would I have done it, and would life have shown up differently? I never want to be on my deathbed regretting a thing.
Chip, CEOs are not known for saying what they really think, and they're not known for being willing to be themselves. You printed your own manifesto of sayings on the actual Lululemon bag. Right. You know, it included one, I think, that people ended up getting upset about. It's about children of the orgasm of life, I think. Right. You wrote in your memoir that I think you said something along the lines of like, I'd rather see a child have a job than just waste away. Right. And then in an interview with a colleague here, you said, I think, some women's bodies just actually don't work for Lululemon pants. What is the point for you of talking like so brashly?
Well, I think it was the culture of Lululemon to be totally open and undefended, and to have every discussion was out on the table. I think especially when you are dressing people and you're looking at all the different types of bodies and the different personalities that want different colors, different shapes, different everything. I mean, there's 1 billion nuances that have to occur and things like that. But really, it's the psychology of like looking at people and determining who the muse is, who's actually going to buy your product, but almost as importantly, who do you not want to have buying your product? And can a brand be everything to everybody? Does that become the Gap? Well, I never wanted to become the Gap, and I certainly didn't want to become like most failed, quite frankly, American apparel companies. I wanted to be distinct. I wanted my market was a very healthy person that was interested in fun and longevity and community, and that's who my market was.
We do not need to relitigate the comment about pants, but I mean, I guess that I could sort of imagine that maybe you've learned that like it just like hurt people's feelings, that people felt left out, and they felt left out because of things they can't control. Maybe you wouldn't say the same thing nowadays.
No, I don't think so. I think, you know, like let's face it here. I probably had done hundreds and hundreds of interviews and said thousands and thousands of things. It's just the roll of the dice, the odds that I would say something that was very truthful that is going to affects how some people think. Now, let's put it in context. I mean, that type of thing was in 2013, just at the start of social media, and nobody really understood social media or the power of it. Now, this is a very interesting statistic, and that was the third most sold book in the world is The Sorcerer's Stone by J.K. Rowling's. Okay, there's
the Harry Potter.
There's the Bible, then Mao, and then it's fascinating when you think about that. 14% of people gave it a 1 star and said it was the worst book they'd ever written. So if you kind of think about any subject or any line that anybody says about anything, you can assume at the very minimum you're going to get 14%. Now, that was a great book. So let's say The average is 22 to 23% of people are going to be vehemently opposed to anything that anybody says about anything.
Listen, I don't think, though, that we should, first of all, I don't want to harp on this too much, but saying something about, yoga pants and writing Harry Potter are different. That if 14% of people who read Harry Potter don't like it, that may be the case. But I guess to make it a little bit bigger, I'm betting that you must have a sense that you're taking a risk. You're making a bet that by saying kind of what you want about bodies or the children line on the bag or child labor, a bet that you're just going to be yourself and you're going to say what you want and you don't really care what's going to happen. I'm sort of assuming that must be like a conscious gamble in your mind, or at least it was then, maybe.
I don't think so. I think it's, it was 2013 was the entering of the stage of the world where people couldn't have an opinion anymore. Or I could have an opinion, but it didn't mean that people couldn't vehemently oppose to it verbally on a platform that would go global. I mean, before that, people said ideas all the time. What it is to be an entrepreneur is to have ideas that nobody else has.
Is there anything, I know that you really orient yourself to the future. Is there anything about the past that you wish now that you could change? Something that you did or something that you didn't do, something that you said or something that you didn't say?
No, I'd say my only regret was I had total control of Lululemon 100%. It was a cash cow making a lot of money. I had 3 kids under the age of 2, and I wanted to be a family man. So I sold to private equity and didn't really realize after selling to private equity that, that people would, I was a very trusting type of person. And, it'll take us 5 years to go public. Well, we went public in a year. Everything that, they had promised me kind of flew out the window. And what really happened is I lost control of the board. And I didn't have A and B class shares, which I could have, easily asked for, and didn't know I didn't have the right advice, which is my fault. And so by not controlling the board, I lost the culture of Lululemon and the growth of where I think it should be.
So your big professional regret is selling to private equity guys and losing control of your board of directors.
No, my regret would more be like I didn't spend time developing relationships with advisors or calling people that had gone through the process before and really understanding, what it is I needed to do. I think I also had surrounded myself with advisors that were also very nice, trusting Canadians, and I think, it's just that private equity isn't set up to, to tell you the whole truth about what's going to happen 3 or 4 years down the road.
You felt you were naive?
Oh, very naive.
What do you want to say to people who are working retail jobs, maybe a job as a barista, a job with a boss, and they really crave doing their own thing, but feel like they don't have the resources or the capacity to actually try? What do you want to tell them?
Well, I think it comes back to what we've been talking about already. Like, do you want to be on your deathbed and go, I wonder if I would have done that or not? What's the point of living a life like that? I'm going to have 2 kids. I'm going to live in suburbia. At 60, I'm going to retire, become a road cyclist, and I'm going to die. It was great because then I'd lived an entire life. If I would have lived the life I'd already envisioned and then I died, that would be boring.
Wait, Chip, where does this idea of the horror of a kind of basic life come from? I mean, you asked what's the point of that? I mean, I can think of some reasons to do it. Just decency, comfort, family, spending time with people you love and enjoy, I guess that's a low stakes life, but I don't think it sounds as bad to me. It sounds like it kind of horrifies you.
Well, it is interesting that I think everybody makes the life basically in reaction to something that happened when they were in their childhood.
Yeah.
And what you're talking about is a type of person who maybe had a very rough childhood and very chaotic childhood, and in reaction to that, they want a very normal, safe, predictable life. Now, you could say I had a very chaotic childhood and everything, but I think my parents loved me, and I think that I was a firstborn child, and I was kind of, whatever my genetic makeup is or anything, I wasn't ever going to